Good morning. It is 9 a.m. here in New York City. This is Yahoo Finance Live. I'm Julie Hyman alongside Brad Smith, and here are 3 things you need to know this morning. Walmart raises its profit outlook again as consumers looking for a bargain boost sales. It sees 2024 fiscal year adjusted earnings as high as $6.46. Food revenue and merchandise sales adding to the tailwind for the nation's biggest retailer. Comparable U.S. store sales for the fiscal second quarter rose 6.4%. That's well ahead of estimates. And the report coming after Target cut its full-year forecast for the top and bottom lines yesterday on weaker sales. Global bond yields ascending as hawkish-sounding Fed minutes add to concern that rates will stay higher for longer. The U.S. benchmark 10-year yield climbing to its highest since 2008. Ditto for UK gilts. German bond yields are also spiking. The move suggests that investors are putting another Fed hike firmly on the table. The question is, how much higher will yields go, and how much of an obstacle will that be for stocks, especially big tech? And Cisco leaning into the AI story. Shareholders like it. The networking equipment leader's outlook for fiscal 2024 undershot Wall Street's estimates, though it did post revenue of $15.2 billion for the fiscal fourth quarter. That's up 16% from a year ago and ahead of the Wall Street consensus. Shares initially dipped after the report, but then they reversed higher after the earnings call, on which CEO Chuck Robbins touted the business's wins in market share and opportunities in artificial intelligence. We are going to hear from him directly at 10 a.m. Don't miss that.
Well, shares of Walmart are in focus this morning. That coming on the strong second quarter report from the retailer. Shares just fractionally higher on that report. Revenue rose 5.7% rather, as consumers spent more money more often. Sales strength was led by a strong performance in groceries and the health wellness categories as expected, along with a big boost from e-commerce. Executive editor Brian Sozzi joins us now to discuss. Hey, Brian.
Big quarter out of Walmart. It is really, I would say, one of the most mind-blowing quarters out of retail this year. You had Walmart U.S. Customer traffic up 2.8%. Target's traffic in the most recent quarter down 4.8%. The comparisons really just continue. Walmart U.S. same-store sales up 6.4%. Target down 5.4%. Walmart's e-commerce sales up 24%. Target down 10.5%. Bottom line is this. I caught up with Walmart CFO John David Rainey this morning, and I asked him, John David, why are you gaining up more business from people earning over $100,000 a year? He just flat out told me, and I have the story on our homepage now, we are not your grandparents' Walmart. And by that, he means they're selling more items, a better assortment online. They're keeping their price points, I think, a lot sharper than Target, especially in groceries. And you see it in a high single-digit same-store sales increase for Walmart U.S. grocery sales, and they're gaining a lot of business as a result. In this environment where inflation still remains high, Walmart continues to gain market share from Target, and I think that's a very important story as we go into the holiday shopping season.
And then what about the whole Pride Month situation here? And, you know, how much, I don't know how we're quantifying, I wasn't here yesterday, I don't know how we're quantifying how much that hurt Target sales when all was said and done.
It hurt Target sales earlier in the quarter. So they flat out said, Brian Cornell, when we talked to him, sales declined the early part of the quarter because customers were upset with them. In some cases, they were going in there destroying the merchandise and aggravating employees. Now, positively, sales did improve once Target reversed that decision and pulled some of those items from the store. So sales improved in the latter stages of the quarter. This is not Walmart's game. You know, Walmart is singularly focused on lower prices. It's not going to make social stands by and large. They're two different retailers. They have long operated with two different mindsets, two different cultures. Not saying it's right or wrong. They just operate and do things differently. But I think this quarter is more about a Walmart out in front of many other retailers in terms of price and becoming a trusted destination to save money in groceries and discretionary merchandise when they continue to be hit over the head with lots of inflation, food, and many other items.
You know, this was my first time actually going in this past quarter. Walmart in a different country, and particularly in Costa Rica, the Walmart experience was similar but different, and noticeably different from what a lot of American and U.S. consumers would come to expect. And one of the ways that I kind of looked at it, I was like, you could see the remnants of Walmart, but you would also say, all right, this could also be looked at as even closer to it. Yeah, I did actually. I got some good stuff from there, things that I needed from a trip. But at the end of the day here, I think there's also just the strong brand value internationally that they've continued to build up on, and that's something that they talk about quarter in and quarter out as well here. here.
Glad you mentioned the international, because it's a key part of Walmart's business that not a lot of folks actually talk about, and I'm guilty of it too. When I get that Walmart earnings release, I go right to the U.S. business. That is what drives this company and drives the company's stock and the multiple. But two call-outs. One, China business for Walmart, very, very strong. And this comes at a time, really, over the past few weeks, we have seen a significant slowdown in China's economy. Walmart looks to be doing pretty well, maybe because of that slowdown. And number two, a little nugget that Walmart CEO Doug McMillon called out in the earnings call this morning, weakness in Canada. He said he just got back from a trip in Canada, and he made I don't know if he was sending a cautionary tale of what could happen here in the U.S. He noted consumers are responding now to higher interest rates in Canada and pulling back on their spending. Maybe that is something that happens later this year as we see the mortgage rates go over 7% and we see rates for other types of loans reset, whatever it is, maybe just a little thing to keep in the back of your mind that maybe a couple quarters from now, this isn't the same type of quarter that Walmart puts up.
I mean, the shares are not doing that great.
Well, the shares hit a 52-week high earlier this week. And this quarter, I would argue, was priced into Walmart stock about 6 months ago. But still, these are eye-popping results from the world's largest retailer from top to bottom. And some of the early analyst notes that I'm getting to my inbox, you're seeing estimates, I think, getting ready to be raised even more. You're seeing a lot of reiterations of buy ratings. And again, when you have a quote like John David Rainey, the CFO of Walmart, telling us here at Yahoo Finance that consumers are essentially going to them because they're saving more money, they're keeping prices low. Now, John David, I asked him, are you flat out cutting prices in this environment? Not necessarily, but I think they are very focused on ensuring their products are priced significantly cheaper than a lot of comparable items at a Target and many other competitors.
It was also interesting that they did better in some of the other merchandise categories, general merchandise categories, than they expected here too. And they called that out within the comments for the quarter. And they had kind of been guiding down in some of those other discretionary categories coming into this.
But still down. So like a Target, this wasn't a perfect quarter. You know, if you wanted to pick out a couple of things here, some of the international locations didn't perform up to snuff. Like Target, same-store sales in discretionary categories like a home goods, like apparel, still under pressure here as consumers focus more on everyday essentials. But as you look to the holiday season, you're really getting the sense this is going to be a holiday season where Walmart wins and maybe wins bigger than a Target.
We'll see. All right. Thanks, Saz. Appreciate it. Well, it's a tale of two retailers, as we've been talking about. In the age of food inflation, of low unemployment, and blockbuster leisure spending, what can we make of the consumer? Two major companies give us two very different pictures this week. On the one hand, Walmart delivering a major win in the second quarter, beating revenue expectations by a wide margin. The value retailer saw strength across categories like grocery, health, and wellness. At Target, though, different story. The retailer saw its first quarterly sales decline in 6 years. It was hit by slowing traffic and rising shrink, aka theft. That's on top of shopper backlash from a June Pride campaign. Target also cautiously lowered its full-year EPS expectations, but Walmart upped guidance on confidence in consumer momentum. As part of Yahoo Finance's week-long special Retail Evolution, the New Era, we're diving into what these earnings tell us about the consumer. With us now to discuss, Jerome Martis is Director of Consumer Research at LSEG, and Dean Rosenblum, Bernstein Senior Research Analyst for U.S. Retail. Thank you both for being here. Dean, I want to start with you here and what we just heard from Walmart in contrast from what we heard from Target. I mean, is it just as simple as consumers wanting to spend less? Is that why Walmart seems to have the edge here?
So I don't think so. I think if I'm being very transparent, I think comparing Walmart to Target directly is something of a false equivalency. They're very, very different businesses. Food and beverage only comprises about low 20s, 21-ish% of sales for Target. It's over 60% for Walmart US, similar Sam's. And in an environment where consumers are stretched and just trying to cover the essentials, a retailer like Walmart, who is the biggest grocer in the world, is going to benefit tremendously from that disproportionate focus on staple spending. Target, on the other hand, is going to see softness in the discretionary categories, which is what we're seeing. And I think it's sort of not a perfect comparison, Walmart to Target, in terms of equivalency.
Jerome, your perspective on that, is it not necessarily as easy as going apples to apples on Walmart and Target?
I'm in agreement. And also, especially because Walmart told us today, that groceries is their biggest seller. That's why they did very strong. Also, their private label is doing really well. But what's key, and trend that we've been seeing a lot with Walmart, is that membership number. Not only have they been gaining new customers, but they've been able to keep the existing customers, and that in return is turning into loyalty consumers that are now extending themselves. What I mean is, today we saw that general merchandise grew a little bit stronger than expected. The very first sign that we've seen that consumers might be feeling better about going back to those discretionary items. But when they do that, the loyalty that they now have for Walmart is allowing them to do that at Walmart as opposed to Target, which is known for the place to go for discretionary items. So this is where we're seeing that Walmart has the upper hand compared to Target. They've gained those loyal customers because of groceries, and now that's converting into them extending themselves and buying general merchandise. Today, Walmart said that big ticket items actually saw a little bit of a splurge.
That's interesting here that, if you're in the store already and you're buying your groceries, then you're going to look in other parts of the store. That's something that these mass market retailers have always pushed for. But I wonder if indeed it is grocery that is bringing them in. Is it not just a Target maybe that's not going to do as well in this environment? Is it other grocers, Dean, that also maybe are going to suffer if Walmart is taking that share?
Yeah, and actually we've seen that. We cover Kroger and Albertsons, and both of them actually grew. Both grew in their recent earnings releases, but they grew slower than Walmart is absolutely gaining share and growing faster than the grocery market overall, and the grocery pure plays as well, including the whole grocery segment. So that's definitely the case relative to grocery pure plays.
And so as we think about some of the other merchandise categories that both of them have had to really fine tune their inventory position on. Dean, I'll put this one back to you as well, because that inventory positioning, a theme that we've heard across some of the major retailers that have reported this week in this earnings season. So is the worst of the inventory preparation and forecasting behind us at this point?
Yeah, I think so. I mean, Target took its inventory down about 5% in dollars in the first quarter, and on units, we estimated it was in the low teens. This quarter, their inventory position was down 17% in dollars versus last year this time. I will remind the viewers that second quarter of 2022 was the trough of Target's inventory write-down despair. Target has also taken a much more cautious approach to procurement of merchandise. So we think, yes, absolutely, there is not another shoe to drop relative to some giant inventory glut and ultimately write-downs and markdowns. We just don't see that as happening.
On a related note, Jerome, I'm curious what we're seeing margin-wise. It actually looks like we saw some relatively healthy margins on the Walmart front. Its consolidated gross margin was up 50 basis points here. And it seems like even though they're holding the line on price to a degree, that they're still managing to expand margins. Is that something we're going to continue to see?
Yes, and this is across the board in retail. The reason being is because we're not seeing those high inventory levels that we saw during the pandemic. A lot of retailers have been managing those inventory levels better, and as a result, they're leaner. Because they're leaner, a lot of these retailers are not sitting on massive inventory that they have to move and discount them. And that is the key right there, the discounting level. Because they've been able to maintain healthy discount levels, that's why we're seeing better gross margins. And that's why, in general, we're seeing that more retailers are beating earnings estimates as opposed to missing. It all comes down to leaner inventory levels and managing those significantly better than during the pandemic.
To what extent, Jerome, just to add on to that, does this come back to wealthier shoppers coming into Walmart as they're looking for some type of trade down, or just to make sure that they're also perhaps going where they could find the best deal?
Absolutely. That was not only evident in Walmart, but also in the TJX numbers of the high-end consumer who we've learned from the luxury retailers is being more conservative and thinking twice before making those impulse shopping. They still want the best brands, but they want to pay significantly less for them. And that's why TJX also saw very strong numbers yesterday. So in general, we're saying that the American consumer, what's really enticing them is those steep promotions. That was evident in the US retail numbers that came out earlier this week for the month of July. July was heavily promotional because of Amazon Prime Week. That helped significant other results as well. And it's the promotional levels. It's that value proposition that's what's enticing the shopper to open. And also a slight sign that we might be starting to going back to normal, to the way things were before the pandemic. That's also evident by Walmart's numbers today, telling us that consumers did buy big ticket items. This is the first time in a very long time that we've heard that consumers are doing that again.
Yeah, it's interesting. Dean, what are your impressions sort of the bigger takeaways on consumer spending here? And I would also ask, is what's good for Walmart bad? What's good for Walmart sort of have negative implications for the overall economic picture in the U.S. particularly?
So I don't know that that's necessarily the case. I think Walmart is absolutely occupying a more holistic place among consumers, even at the top end of the income spectrum. But recognize, though, that we don't actually have absolute numbers on that. We do know that it's growing based on reports from the company, their penetration of higher income households. But it's also the place that they have the highest opportunity to gain incremental customers. So it's kind of like if they're going to gain incremental traffic and incremental shoppers, it's sort of where it has to come from. I don't necessarily see it as sort of a zero-sum game that if Walmart wins at the higher income, that everybody else loses. So, I mean, we'll see how it shakes out. I think Joe's point about Walmart gaining customers and the extent to which those customers stick will be absolutely something to keep an eye on. One point on the large ticket discretionary, though, all of the companies that we cover that sell both staples and discretionary, particularly big ticket discretionary, have reported prolonged softness in big ticket discretionary. That's true for the home improvement retailers, it's true for Costco especially, and that it's we're seeing signals of it starting to bounce back at Walmart, I think is a positive sign for the economy overall. And that's certainly something we're keeping an eye on. And as an aside, as it does come back, the discretionary spending return should accrue beneficially to Target disproportionately given their mix, particularly in home and apparel.
Well, Dina, sort of to follow up on that, we began the conversation by you saying it doesn't necessarily make sense to compare the businesses directly because they are quite different businesses. From an investment perspective, though, if you're looking at them, you might be saying, I want to buy one over the other. And you do, if I'm not mistaken, you have an outperform on Target and a market perform on Walmart. Can you talk us through that, especially given what we've heard in the last 48 hours from the two companies, why you prefer Target over Walmart?
So the very short answer is Target is priced for desperation and Walmart is priced for perfection. With Walmart's results today, it's, I think, an interesting point to note that the stock is essentially flat on the day, despite the wild top-down beat and the guide up for balance of year. Whereas Target missed on top line yesterday by mid-single digits, and the stock sort of barely blinked. And I think the reason for that is the concern with investors right now is Target's ability to restore its profitability. And we saw an EPS and operating profit beat from Target yesterday. It's all about the upside from here. And for us, Walmart's priced for perfection. And we may not be at the bottom on Target now, but we are a long way from the top. We're a pretty strong advocate of Target here.
Jerome, if we were to see any type of shift in how consumers are spending or their confidence even to start matriculating back towards some of the more luxury end of the goods spectrum, even though a lot of that goods and services spending has shifted into that services era or element, all that considered, if we were to see a shift among that consumer kind of appetite to go back into luxury, what does that net out for Walmart? How do they use this time, from your perspective, to really kind of capture the attention that has been thrust back towards their direction?
I think in terms of Walmart, when consumers think of Walmart, as we mentioned before, they've gained a lot of new consumers. The membership has gone up, especially from the high-end consumer. But that high-end consumer, if they're going to gravitate towards extending themselves at Walmart, is going to be with those big ticket items like electronics during the holiday season. Walmart is not the destination for luxury items. In general, when we look at the forecast for the second half of the year, we do see that consumers will be sticking towards services. That's still where the money is gravitating towards. But to your question, if the high-end consumer were to splurge at Walmart, it would be more towards electronics during the holiday season and during the fourth quarter.
Just briefly here too, is there anything that we can extrapolate from this report about what the company is signaling in terms of back to school season and the strength of this back to school season versus years past, given all the projections that we've got from NRF and everybody and their grandmother at this point, anecdotally in some of those cases?
So a lot of that Amazon Prime Week definitely moved those back to school sales into the month of July. That's what we saw, strong July US retail sales numbers. And a lot of that was driven because of the promotions. When you looked at that Amazon Prime Week and you went to any of the websites, Target, Walmart, the landing page was always back to school. And parents, no matter how the economy is doing, back to school happens every year, and parents took advantage of those sales that were strong enough to entice them to open up their wallets. So we saw a lot of that back to school in July. We might see a slight pickup in September when students go back to school, eye what their classmates are wearing, and then go back to the mall to buy those latest fashion items.
All right, latest fashion items for me. More flip-flops. Jerome Martis, Director of Consumer Research at LSEG, and Dean Rosenblum, who is the Bernstein Senior Research Analyst, U.S. Retail. Thank you so much, both of you, for joining us this morning. Appreciate it.
Thank you so much.
Thanks.
Take good care.
Thank you.
You too. Well, switching gears here. U.S. 10-year yields, they are climbing towards their highest level since the financial crisis, as continued resilience in the U.S. economy pushes investors towards the possibility for further interest rate hikes. July's Fed minutes are also adding to the momentum. Investors are now seeing a 40% chance of a rate hike by November, after the release showed participants are wary of the possibility that inflation will not ease and further hikes will be necessary. A quote from the minutes says most participants continue to see significant upside risks to inflation, which could further require tightening of monetary policy here. Now, one, of course, tool that we always kind of look at to see where things have been moving around, CME FedWatch tool, just to see where some of those probabilities are. As of right now, where we're sitting is still for the next meeting in this September meeting for no hike and for them to just really look across the data that continues to come in. But then once you get out to that November meeting, that's where we start to see things get a little bit more of a toss-up scenario, with only 60% of it leaning towards a no hike versus the 40% or 36% as you're seeing here on the screen. This moves around a lot for a 25 basis point rate hike as well.
Yeah, whether you get there are a lot of different schools of thought on all of this. One school of thought says, well, if they raise again or they don't raise again, it's somewhat marginal because a lot of the tightening that has already been done is still making its way through the system. There's another school of thought that says that they've already tightened too much already, and any more will perhaps cause further damage to the U.S. economy. Whatever school that you are in, indeed the minutes yesterday seemed to tilt more in that direction. But I found a note from Krishna Guha, Evercore ISI vice chair, interesting on this point, who called this an emerging tension between inflation data that is moderating faster than the Fed anticipated and growth data that is coming in stronger than the Fed anticipated. So this is really the conundrum that the Fed now has on its hands, because can inflation data continue to moderate while we are seeing the growth numbers that we are seeing? For now, yes, although many economists we've spoken to have said we could see a reacceleration of inflation before year end. What's interesting is Krishna still thinks we are not going to get the Fed raising rates once again because he says downside surprises on inflation mean the real rate path is already higher than anticipated. In other words, it sounds like he still thinks the Fed is going to weight more heavily the inflation data compared with the growth data going forward.
And on that data front, I mean, data continues, as they had talked about in their meeting and as was shown through the minutes, data is continuing to point towards a robust economy, but retraced part of that move after the June Consumer Price Index release was interpreted by market participants as softer than anticipated. And so it's some of that softness and areas of weakness or softness that the Fed is continuing to monitor to really figure out, okay, have we done enough tightening at this point, and where do we avoid the risk that you're bringing up of over-tightening towards what has been taken off the table from many of our conversations, an all-out recession. It seems like we've moved into the swift or easy soft landing, without a potential recession.
Right. Something else Torsten Slok of Apollo pointed out is that you have an unusual amount of agreement among the Fed officials, which is kind of interesting here. He's been tracking the dissents and says the dissents are going down and agreement is going higher. One final thing, as we look at bond yields, where they are this morning, that has been a real headwind for large cap tech in particular as of late, with yields where they are. The 10-year yield now at 4.29%. It's touched 4.3 also, so that's something to keep an eye on. It seems to have had diminishing returns or diminishing obstacle to large cap tech as of late. It doesn't seem to be as much of a problem, but we'll see going forward. Absolutely. Because that's something investors have been watching closely. All right, we got much more markets action coming up, including the opening bell. You're watching Yahoo Finance.
We got to know, Barbenheimer, have you taken place in the phenomenon? Did you see both movies? Did you see either or?
Oh, I feel bad. I haven't seen either yet. It's on the plan. I plan to go. I just have to get it on the books.
Okay. Plenty of pink there in the theater when I saw it. I got dressed up myself, so highly recommend for some people to take part. It's, fun summer activity.
Let's take a look at some movers right now and start with Cisco. The shares higher by almost 3% on the back of the company's earnings call. The stock did initially drop after its weak full-year forecast, but investors then doubled back after CEO Chuck Robbins touted positive AI potential here. This is something we've been seeing now and again during this earnings season, right? That the company talking about that, the longer term case for an AI giving a bump to its business is what people are looking for. The company said it has $500 million in orders for AI products. And so that's something that it touted on the call as well.
Yeah, we're about to get into the sassy part of earnings season where you hear a lot about where artificial intelligence can play a role in software as a service type of companies, and where that's going to make a difference perhaps in the number of users that companies decide to secure licenses for, or just the types of products that they decide to buy into. Since I'm talking about products and services, let's break out those two particular segments as they define them for the company. Products were up by about 12%. Revenues were, at least in this most recent quarter. And then service revenue, that was up by about 9% in this most recent quarter. They're expecting 51% of total remaining performance obligations, RPOs, you're going to hear a lot more about that too, to be recognized as revenue over the next 12 months.
Yeah, and some of the analyst commentary around this caught my eye. I have one sort of less excited comment and one more positive comment. So Piper Sandler said the company's continuing to get a boost from a flush of its backlog, that it's basically delivering that stuff as supply chain pressures are easing. But Piper did point out that product orders did come in better than feared, but still fell 14% year over year. So that's on the less enthusiastic side. But then you have Morgan Stanley that said the results were a pleasant surprise and that the company continues to be what it called a shelter in turbulent times in the sector.
Wow.
So a little bit of meh, a little bit of good there.
It's a little bit of a rose in the middle of a storm for you.
I guess so, yeah.
Stay tuned for our executive editor, Brian Sazi's conversation, the interview with Cisco CEO Chuck Robbins coming up 10 a.m. Eastern Time. You do not want to miss that.
Yes, I'm sure we'll hear more about AI. We just had the opening bell on Wall Street. Let's do a quick check on the markets here. Stocks moving higher even in the face of those surging bond yields that we were talking about just a little while ago. Quite interesting to see that activity, as I said, not being as much of an obstacle as it was when we were seeing a sharper tech sell-off. The Nasdaq, indeed, is up about 0.4%. All three major averages up by at least about 1/3%. So let's get over to Brad at the Interactive for more details on what's going down today.
Yeah, taking a look at the Nasdaq Composite, as you just mentioned that a moment ago, up 0.3%, past 3 days down by about 2% here. This, as an interesting August, has certainly sputtered forward here. S&P 500, you're seeing that down over the past 3 days, down by about 1.6%. Here today, higher by about 0.3%. So we'll see across the board if we can bounce back today after some consecutive losses that we had seen this week. Dow Jones Industrial Average, though, you're seeing that up, holding on to gains of about 0.25% right now. Let's take a look at 11 S&P 500 sectors here on the day. On the morning, you're seeing them mostly green right now. Energy is actually leading the pack. You're seeing that higher by about 1.6% right now. Let's populate a chart of that just to give you a reminder of how interesting it's been over the course of this year. Just barely higher. It's up by about 1%. So that coming off of the big 2022 that energy had, really leading the pack there. However, one of the other stories that's been interesting to track, at least this morning, and this will kind of tee up our next conversation, healthcare is actually bringing up the caboose here. The lone decliner in the 11 S&P 500 sectors on the day. You're seeing that down fractionally, just flat, just barely to the downside there. Staples flat, barely to the upside here. And then also just keeping a close eye on technology here, as we're going to have a few more companies in our eyesight this morning that we'll break down in a hot second. And then also, speaking of technology, just a brief look at the Nasdaq 100 here. So mostly green on the board. That's a good thing. Mega cap tech stocks, mostly green there too. Google leading the pack for those mega cap ones, the blue chips. That's up by about 1% as of right now. Alphabet, Google, whatever you call them up right now.
All right, and let's talk about some other movers, shall we? We'll get to that healthcare one you were talking about in a second, but first, got to get to Tapestry as we continue on this retail theme. Those shares aren't doing a heck of a lot. The Coach parent company gave a weaker than expected guidance, saw sales at Kate Spade and Stuart Weitzman fall from a year ago. This report coming, of course, after Tapestry announced the purchase of rival Capri Holdings in an $8.5 billion deal. That happening just last week. So it's interesting to see the shares little changed here. If you look at the numbers, the company's forecast for the full year, its fiscal 2024, is at most $4.15. Analysts have been looking for $4.22. Revenue likewise coming in a bit short of estimates. If you look at the forecast, I haven't had a chance to take a look at headlines from the call, but it's possible that commentary they made is helping the shares from decreasing on what looks like sort of lackluster numbers here.
Yeah, I mean, it comes just after a key acquisition to tie up, especially in that luxury landscape between Tapestry and Capri. And you got to think going forward here for investors that have already seen the acquisitive nature that this formula of Tapestry and really bringing in together several brands under its helm that many years ago between the Stuart Weitzman and Kate Spade and Coach kind of combination that they were able to make then, and now adding on even more of those kind of high value, high cost type of names and brands into their portfolio. What they're saying about that, they had talked a little bit about that, just particularly in the press release, saying that they're establishing a new global powerhouse of luxury and fashion brands that expands their portfolio across consumer segments, geographies, and product categories. Still, a question lingers perhaps of whether or not they overpaid for that acquisition as well. A considerable premium to what the market valuation was. Yes. For Capri.
Although Simeon Siegel, who we talked to at BMO Capital Markets, said it's a depressed valuation coming into that offer. So nonetheless, the Tapestry shares have been falling pretty much ever since it announced that deal. So that is something to think about as well. I was just trying to search the conference call for some comments on Capri, and they did talk about it and talked about the case that it will create significant value for the two companies. Of course, we shall see over time if that is indeed how it works out. But the shares, little change on the back of these numbers.
And just, additionally, the type of consumer that they're going after, too, right now, where you've got more of the engagement with Gen Z and millennials that they're trying to drive forward. They talked about that in the press release, driving customer engagement across brands, acquiring 6.5 million new customers in North America alone, roughly half of which were Gen Z and millennials. So particularly interesting what type of customer lifetime value they can get out of that relationship with the cohort as well. Also, we got to talk about shares of CVS here this morning. They are sinking after Blue Shield of California will reportedly no longer use the pharmacy chain's Caremark for drug pricing and other services. Now, it will instead build out new relationships, including Amazon and Mark Cuban, according to the Wall Street Journal here. You're taking a look at shares of CVS Health. They are moving lower this morning by about 7% here. Blue Shield of California represents about 4.5 million healthcare plan members. So this is significant, not just in the announcement, but in the move. And for CVS, they represent about 33% of the market share for pharmacy benefits management businesses out there. So this is why you're seeing the shares react in the way that they are this morning.
Yeah, it's interesting. I just checked on Amazon shares. They're not moving that much, even though they are getting the mail or the at-home drug delivery part of this business, which seems like it would be a big win for them. It's a young business for them.
Base pill pack makes sense.
Yeah, but it's not seeing much of an upside from that. It's more of a problem in investors' minds, at least, for CVS than it is a benefit for Amazon. But this is a pretty big sort of shift in the industry, it feels like, for Blue Shield to be making this move.
Yeah, and I think it's amazingly significant. And if it does at all kind of get other players out there thinking, and I think some credit due to Mark Cuban here too, who made a very strategic play to get into some of the, and at least try to cut into the pharmacy benefits management business through just being able to distribute some of the different pills, and I was looking for a better way to put that, but prescriptions rather, that were a little bit more easy access, were kind of running out of some of their own patents even in some cases. And so with all of that considered, trying to make sure that it was more affordable. And I think that's where he made a very strategic play. And, it would be interesting to see if there's anything communicated from that business here today as well. But, at the same time for CVS, this is a significant loss. It'll be interesting to see where other companies who are managers of health plans, if they make another decision that adds on to this, perhaps.
Yeah, so the CEO of Blue Shield California is Paul Markovich, and the Wall Street Journal, which first reported on this, has some interesting commentary from him. They cite him as saying the current pharmacy supply chain is a forest of opacity and profit. It is overwhelmingly complex. It is designed to maximize the earnings of the participants, and he said now changing that for Blue Shield will be flipping that on its head. He also said that this they're going to fully implement this by 2025, and then it will save Blue Shield $500 million annually, which they plan to pass on to participants. So again, to your point, if a big player like this is making this change, that raises the question of who will follow. Maybe they won't follow right away because they'll sit back and say, how is it going to work? Sort of mark the success of it. But nonetheless, it seems like a big shift on their part.
Yeah, absolutely. I was just taking a brief look at Cost Plus, of course, Mark Cuban's drug company that was also kind of looped into this broader decision too. Nothing I've seen posted so far, but really interesting to see if there's anything said about this announcement and, what this means for the industry too. Everyone, we've got much more markets action straight ahead. Stay tuned. You're watching Yahoo Finance. Everybody's been keeping an eye on China, and there's been some very not so good, not so fun type of economic data that's come out of there. There's been lackluster economic data from China compared to the expectations coming into this year. Are we witnessing, as some have kind of leaned back to and called it, are we witnessing the makings of a lost decade for China?
Well, I think the challenge is, really this highlights how out of sync different economies are globally right now. You're really seeing the US in a very different situation than Japan, than China. And you could be right. They've really had a lot of tremendous economic growth. And it also highlights that it takes longer to get out of a difficult period than people really expect.
Officials in China are reportedly stepping in to stem volatility in the yuan as weak economic data out of the world's second largest economy weighs on the currency and the equities markets. Joining us now to break it down, we've got Yahoo Finance's Jared Blickry from the floor of the New York Stock Exchange. Hey, Jared.
Good morning, Brad. Let's take a look at the Wi-Fi Interactive, and I'm going to break down how the Chinese monetary authorities and government officials, our state officials, just kind of guide the economy. I'm going to put actually the US dollar versus the Chinese yuan. You can see the US dollar has appreciated by 4.5% from the lower left to the upper right on this chart. And the problem is with this level right here, 7.2871, that's all very close to 7.3. That is a psychological level that has been important in the past. And in fact, if I put a max chart of the dollar versus yuan, and again, if it's going up, that means the US dollar is gaining strength and yuan is weakening. This is the highest level we've seen since 2007. That puts pressure on the economy. And the problem with the Chinese authorities is they're trying to stimulate their way out of this without causing, well, too much stimulus. So they're trying to do it targeted. And right now they're advising their state-owned banks to deliver targeted yuan deliveries. And so the currency is devaluing, but not at a wholesale level. The problem with devaluing the currency is that you get capital outflows. People over in China don't want their currency as much, and so they sell it, and then they invest in things like the US dollar. That's not what the Chinese authorities want. So they're playing this very delicate game, like all central authorities, like all central banks do, but with a different set of rules. Now, you take a look at the Wi-Fi Interactive one more time. Here's what's been going on in China today, but check out the last 5 days. A lot of red on that screen. I'm going to sort by performance so you can see on the bottom row, everything down by about 10% or more. So things really kind of coming to a head in China with the whole reopening story having unraveled. The question for the authorities is, what can they do next that doesn't stimulate those capital flows, which they don't want?
All right, Jared, we'll continue to watch those numbers, of course, very carefully to see also what kind of effect it has on the U.S. companies that operate in China. Jared Blickery, appreciate it. Well, following the massive tech stock rally that came amid the first quarter results season, this quarter has been more rocky, with more than 80% of S&P 500 companies reporting earnings. It's obvious that investors aren't so easily impressed this time around. According to FactSet, companies that have beat earnings in the second quarter have seen an average price decrease of 0.5% 2 days before the earnings release through to 2 days after the release. That marks the largest average negative price reaction to positive EPS surprises since 2011. Just to give one example, Tesla down almost 20% since reported its earnings a month ago, despite beating expectations. Joining us now, Dana Doria, Envestnet Co-Chief Investment Officer, to talk more about how we are seeing these companies react and also what else you're seeing in the market. But let's talk about earnings first here and the sort of diminishing returns from beating estimates. What is it going to take to impress investors at this point?
I think there's a lot that's being macro-driven at this point. So certainly we had a remarkable first half in the markets. And, that came as a surprise, I think, across the board pretty much, right? There was an expectation coming into this year that you were going to have lackluster markets, recession probably starting mid-year, second half of the year. And it just hasn't materialized. And it's been a phenomenal first half of the year. But now, of course, as markets do, they're sort of weighing, new information coming in. Is the Fed really going to back off? Are we going to see more rate increases? And when you have an earnings season, even beating, but valuations are high, it's going to just take a little bit more, I think, to kind of ease the market's concerns that maybe perhaps we've priced in too rosy of a scenario.
What are investors looking for then? What are they trying to hear from CEOs to give them confidence that would actually warrant, even if a company does beat on both earnings and revenue expectations and give upbeat guidance, give them all of the kind of elixir that they're looking for?
I think there's an element to it of EPS growth for next year that's being looked at. What is forward guidance? We've already priced in an expectation almost that, we would be doing well this year. But I do think there's also, as I say, a macro aspect to this. I think there's, concern among investors that the individual companies will in fact be harmed perhaps by, we now have obviously rates rising in the 10-year, hawkish comments coming out of the FOMC meeting, which shouldn't be a surprise, but markets tend to, absorb these things as they do. So I think, hearing that we're beating, but that perhaps we're not forecasting, the growth that we would like in 2024 can be concerning. I think also that if you think rates are going to continue to increase, you're concerned about places in the market that are doing well, growth, right? These tech, big companies that, perhaps, and tech in general, growth in general, where interest rates make a big difference. Interest rate rising have to bring up concerns about banks again, regional banks. We've obviously
at the beginning of the year and when we were seeing problems there, that was considered by many to be the sign that, okay, something's breaking now where the problems are beginning, kind of dissipated, right? We came in and, kind of took care of those concerns, but that is really coming back to the fore now, and you're seeing those kind of concerns seep back into the market.
Although it's interesting, we're seeing rates at their highest since around 2008 when you look at the 10-year. Tech's doing okay today. I'm just looking at the KBW Bank Index. It's up today.
Yeah.
So at what point, at what level would yields really start to become problematic for these challenged areas again?
I think some of it has to do with how dependent the individual companies are on, the credit markets. So you're going to see it more in first, I think, in small cap areas where there's just complete dependency, and you are seeing a little bit of that, right? And to the extent that rate hikes are more than what the market is pricing in, this expectation, what is going to happen in September. Even whether we get the hike or we don't get the hike, right? There's an element of, okay, but over the long haul, what are we looking at? Is it higher rates to go, or what we're pricing in now, of course, is rate decreases next year. Is that going to materialize? And we know that the FOMC meetings were a bit hawkish, and we know since then we've had some data that suggests that the Fed has no reason to reverse course on hawkishness. Now, obviously, there were some who disagreed. You saw a little bit more dispersion in the comments that came out. But if you're leaning toward hawkishness, I think, the data that's come since that meeting kind of only pushes you that way, right? We saw a little bit of cracks in unemployment, and that kind of reversed. Jobless claims, came back in under. You're seeing inflation moderating a lot. That's great. GDP blowout, basically, reading, right? Retail sales up. So the expectation about what the Fed's going to do is probably going to largely lean hawkish. And if that's the case, to the extent that that impacts these companies, to the extent that they're in credit markets, you would expect that to experience that.
To what extent has the international part of the equation been a looming cloud over this earnings season?
I'm somebody who looks closely at valuations as the metric, right? If you look across research on markets and what really does, at the end of the day, drive expected returns over time, valuations are a big piece of it. And international markets are valued well comparatively with U.S. markets now. And I don't necessarily think, we represent the retail clients, right? Advisory clients. I don't know that that's really well worked into how they're viewing. And I think to a certain extent, it should be, right? That benefit from diversification. You may not experience the same level of growth, you may not expect to, but at a certain price, something is going to make sense more than something else, right? That's priced to more of a perfection.
What about in the U.S.? What is more attractive on that valuation basis?
So I do say to tend to tilt value. Look, it's really hard to argue with what tech has done and now communications, right? The enormous 8 has done. AI is probably what's carried us through the first half of this year. Let's be honest. There was this AI boom that nobody sort of saw coming. I tell you, we worked with hundreds of money managers, and many of them were coming in saying fixed income focus going into 2023, right? And here we have an AI boom, and suddenly there's this possibility for this great outcome. But at the end of the day, if you look at the average retail client's portfolio, whether it's actively managed or it's just market indexed, they have a ton of that type of, right, tech, the enormous 8, inherently that bet on AI. So I tend to say, look, to the extent that you want to be in markets over the long haul, you're not worried about, which you shouldn't be, right? You're not so much worried about what's happening in the short term. Tilt a little bit towards those lower valued companies, towards the sectors maybe that are throwing off cash flow, but are not necessarily exciting and bringing that AI type story to you, because over the long haul, they do tend to outperform. And also defensive. Right? So think healthcare in terms of, if I want to be in a sector, I want to be in parts of the market that, they're plodding forward, but they tend to be defensive over time. They tend to have good quality indicators. We know these types of companies do outperform over the long haul. So I'm not saying take tons of tracking error to the overall market, but to the extent that you're going to tilt in your portfolio, I recommend tilts towards quality type companies, high profitability companies, value or names.
All right, Dana, thanks for coming in. Good to see you in person. Dana Doria is Envestnet Co-Chief Investment Officer. Appreciate it.
Thank you.
We got much more coming up. Stay tuned. You're watching Yahoo Finance.
A lot of debate right now about where the end call button is going to go on the Apple iPhone. And there's some new changes with the new iOS 17. Where do you believe the button should be? Should it stay as is at that bottom center? Should it go up into this new placement where you've got to figure out, all right, am I pressing the right button? Of course, it's usually the only red button that's there.
I have to say I like things not to change in that way. I already have enough trouble with trying to get adjusted to the new version. So I'd rather it stay a little similar, but I'm sure it adapts. So I think they know better than I know.
We got some big interviews on tap in the next hour. Our executive editor Brian Sozzi, in just moments, is going to speak to Cisco CEO Chuck Robbins on the back of that company's earnings. So stick around for that.
Let me get a hoo-ha for earnings season and another executive shakeup. We'll speak with the man set to take over the helm of Synopsys on January 1st. Stay with us. All your markets action straight ahead. You're watching Yahoo Finance. Nobody envies the job of the Fed, but if we were to put our Fed shoes on and hat on, what do you kind of signal as the tenor in the next meeting coming off of the economic data that they've seen thus far?
Well, I think the challenge that the Fed has is that everyone wants things back to normal way too quickly. And so they have to kind of temper their response to try and help everyone see that, this is a fight against inflation that's going to take a while. And that, as long as economic conditions are good, we're going to just have to stay in a higher interest rate environment for longer.
Welcome back. It's just after 10 a.m. in New York City. This is Yahoo Finance Live. I'm Julie Hyman. We're about 30 minutes into the trading day, and let's take a look at how stocks are moving right now. We do have the S&P moving up a bit here, not even a fifth of 1%. Stocks sort of mixed here as investors continue to digest the Fed's meeting minutes and what the participants' sentiments mean for further policy tightening this year. Yields have been seeing a lot of impact from the Fed. They continue to spike this morning, driven by the resilient U.S. economy and the possibility of stubbornly high inflation. We see oil stocks outperforming. Looking at individual names, shares of Wolfspeed are plunging this morning after reporting a wider than expected loss and forecasting further losses for the current quarter. The company blaming significant factory startup costs for those losses. Also watching Adobe, Bank of America upgrading that stock to buy from neutral, saying the software company is on the verge of becoming a leader in artificial intelligence. This comes after Adobe released AI-powered features to Adobe Express. That's its cloud-based design platform. The features have been in beta since June, but now users can use generative AI text prompts to create custom images and text effects in over 100 languages. And we're also watching Ball Corp, the stock popping on news that Britain's BAE Systems agreed to acquire Ball's aerospace assets for about $5.5 billion. Ball, known mostly for making aluminum cans, but in its second quarter, its aerospace division accounted for about 14% of sales and 15% of operating profit. BAE's stock is falling on the news as investors consider the price the company is paying for that Ball unit. Now we're going to send it over to our executive editor, Brian Sozzi, with a big interview for us. Soz?
All right, thanks so much, Julie. Cisco 2.0 looks to be unfolding in front of investors. Tech giant beat big on the top and bottom lines as it continues to ramp up and focus on artificial intelligence and also give more money back to shareholders. Joining me right now is Cisco Chairman and CEO, Chuck Robbins. Chuck, nice to see you.
Nice to see you, Brian. Thanks for having me.
So coming into this quarter, I think there was a lot of pessimism on what you would report. Some company, I would say, called Juniper, I think sparked a lot of worry in the marketplace, but I didn't really see that in your results. Sales up, product sales up 20%, service revenue up 4%. What did the market get wrong?
Well, I think the primary difference between some of our peers is that they have a higher concentration or a higher exposure to the service provider segment, which was weak for us as well. But we have a much more diverse book of business, and so the enterprise and public sector and commercial all offset it. But look, it was one quarter. Teams did a great job. We're really happy with how they executed, but still a lot of dynamics out there.
And the margins in your business up pretty significantly as well. Is that just inflation coming down and you benefiting from that?
Well, a lot of it is a lot of the costs that we incurred with the supply chain challenges have subsided a bit. But it's also just the teams do a great job. Our supply chain team and our engineering teams do a great job on just continuing to find efficiencies in how we build our products.
This is a strange time in the economy. And look, I mean, today we have Walmart coming out here saying more people making over 100 grand are shopping its stores. Who would have thought? It's Walmart. What's your read on the economy here? Make sense of it first.
Well, I'm not sure I can make sense of it for you, but I think it's clearly mixed. I mean, we as I said, we saw improvement in our commercial, which is sort of the mid-market down. We saw improvement in our enterprise business, and public sector was pretty steady. But service provider was very weak, and I think there's industries that are doing okay. We saw financial services, transportation was strong, but I think it's just a little mixed and just a lot of dynamics that we're watching on a very regular basis.
What are you most concerned about as we go into the back half of the year from an economic standpoint?
Well, first of all, I think that technology has become so core to how organizations run. This is it's not an optional thing. It's not a cost center. It's not some underlying ERP system anymore. It's deep in the heart of the strategy of these organizations. So there's not as much likelihood that you just completely stop spending on technology. Most of our customers will say, that's the last thing we'll stop spending on right now. They're being more thoughtful about which projects are being funded, which ones are the most important, and which ones that they're going to focus on. But as we look to the second half of the year, I think obviously getting inflation under control will be really important. Geopolitical dynamics around the world are very important, and hopefully we will see inflation continue to subside over the next few months.
What's your read on the China economy? I think markets are really under pressure right now because of a China economic slowdown. You have exposure there. Are you seeing that?
Well, we are very lightly exposed to China. It's less than 2% of our business, so it's not a significant part. But clearly, it seems to not be coming back online as fast as everyone expected them to. And I think that they'll continue to work the policy. They'll lower their rates, which was interesting. And I know that the economic growth in China is one of the most important topics for the leadership there. So I would expect they'll continue to make whatever moves they need to make.
Do you think we'll see, or are you seeing any signs of a contagion? China slowing down, we're going to get that here in the U.S.
Not at this point. In fact, we saw improvement sequentially in the U.S. Again, it was one quarter, but we saw improvement.
In terms of sequential improvements, you did call it out in the earnings call. Where are you seeing customers come back a little quicker than you thought?
Well, enterprise in the United States, our large enterprise customers, particularly financial services, it was our largest enterprise software agreement quarter in the history of the company. So, big customers making big commitments, and didn't hear a lot of, well, I think we're just going to push that off a bit. When you think about the need to invest in cybersecurity, the need to invest in this whole technology re-architecture for this multi-cloud world we live in, everybody's rebuilding applications and needs observability and insights that we can provide to them. Everybody's trying to solve this hybrid work problem, and everybody's focused now on leveraging technology for sustainability. So, every customer, and so we're just fortunate there are a lot of things that we have a role to play in.
When does Cisco start cleaning up on AI?
Well, it's important to understand the actual technology, and these GPUs, which are the brains in these AI networks, they have to be connected. And there's a technology that has existed for a while that is currently connecting those, and we build obviously Ethernet infrastructure, which is what the cloud providers want to move to. And so we're getting some early wins with some of this next generation Ethernet. But we think, that the FY24, which we're just starting, we'll see some benefit, but we think the real move to this new technology for connecting these GPUs will be in fiscal 25.
So you've incurred $500 million in the most recent quarter from AI-related, chips, Silicon One, is it called?
We said we've taken $500 million in orders to date. It wasn't all in that quarter.
Wow.
It's actually systems that are connecting these AI processors, basically. So they have to be connected at the end of the day, and so we actually provide the networking equipment underneath, and we think that the opportunity over the next 5, 6, 7 years could be, 3 times what the original cloud build-out was.
Can you make enough of this technology? I think all the stories right now are you look at what NVIDIA is doing. They're leading in many respects these AI chips, but they can't make enough of them. Can you make enough products to service the demand you're seeing?
Absolutely.
Okay, all right, fair enough. Now, in addition to AI, you sounded a little different in terms of capital commitment, returning more cash to shareholders. Why that shift in tone?
Well, we've been talking to a lot of our shareholders. We talk to them quite regularly, obviously, and it just became apparent that what they really wanted to see was they wanted to see more consistency and a higher level of buybacks, which we have the balance sheet and the cash to do. And they wanted to see operating leverage. They wanted to see earnings per share grow faster than revenue. And ironically, we've been doing both of those things for the last, we had leverage in the model, growing EPS faster for the last couple of years. And we had increased and gotten very consistent with our buyback, but we had never declared that as a permanent strategy. So really what we did yesterday is we told them that this is our strategy going forward, and you should expect it from us in the future.
Does a commitment like that mean Cisco is out of the big M&A game?
No, we have plenty of, we have a strong balance sheet. We have a lot of flexibility.
Lastly, the WebEx business, under a little pressure as people, I guess, go back into the office and do their thing. What's your commitment to that business? And then, more broadly on the return to office, where do you stand? Do you want to see your employees back in the office?
So first of all, in our collaboration portfolio, the teams have done an amazing job. Most every customer right now is transitioning to cloud-based calling. And so our teams have shifted and are leading with cloud-based calling and collaborate, and the meetings portion of it is part of the suite that they get to do that. So our actually meetings orders last quarter were up double digits. It was actually quite positive. And that overall portfolio was up significantly. Our cloud contact center, which is also part of that, which is customer experience being delivered from the cloud, was up triple digits. And so we're very committed to that business. As it relates to hybrid work, what we've told our teams is that, we let the team decide how frequently and how valuable is it for you to be in the office together, and then they make that call. But we see a slight increase as employees are starting to want to come back to the office. And our general belief is that we're changing all our offices because we want them to be a magnet and not a mandate. And we want people to want to come back.
Do you see your productivity go up as people get back in the office?
We just had a record year. So but you got to remember, we were in this mode to some extent before the pandemic. 70+% of our first line managers have at least one remote employee already. We already had 12 to 14% of our employees that worked from home full time. Based on the job they were doing, was fine to work from home. So this was not a radical new thing for us. It's just a little more broad-based than it was before the pandemic.
All right, let's leave it there. I know it's a busy post-earnings day for you. Cisco Chairman and CEO Chuck Robbins, always nice to see you. Thanks for coming down.
Thanks, Brian.
Appreciate it. All right, all your markets action straight ahead. Stay tuned. You're watching Yahoo Finance.
It's been a lot of debate here in the city as new pickleball courts are popping up everywhere because some of the old tennis courts are getting reconverted now, and you've got a wave of pickleball players. Have you tried pickleball yet?
Yes, I've tried pickleball, and I actually like paddle, which is very popular in Europe. I don't know
What is it?
What paddle?
Paddle.
Paddle. It's so popular in especially in Spain. It's similar to pickleball. So when pickleball got exciting, I had to try it. But I have to admit, I like paddle a little better. There's a back wall. It's a little bit more like squash. So definitely try it out. It should be the next wave after the pickleball wave kind of phases out.
That was my first international trip this year. Nobody told me about this paddle. I need to try it.
You gotta go check it out. It's a phenomenon, especially in Spain. And it's really sort of, the racket is rounder and harder, and there's a wall. And so you basically bounce it off the wall. So it is a mix between pickleball and also squash.
Oh my gosh. All right,
I'm ready.
Try it. All right, I'm setting up my next trip to Spain now. Walmart shares are slightly up as the market digests no, they're not anymore. They're down 1%.
Oh, look at that.
Yeah, interesting. The retailer's strong second quarter reports not helping at least as of right now, but the markets move a lot of different ways. In terms of some of the different stats that we're tracking here, there's been some strength led by strong performances in groceries and health wellness categories as expected. E-commerce also gaining a big boost in the U.S., up more than 20%. Our own Brooke DePalma has more of the color on this, joining us now with the latest from Walmart's earnings call. Brooke.
Good morning, Brad. Good morning, Julie, as well. I mean, certainly we got lots of color on some drivers that you mentioned previously. The retail giant continues to gain market share from all income demographics. They're highlighting that on the call. They said that that's been pretty consistent now for 5 or 6 quarters. They said the customers really care about value as well as convenience here, particularly in that grocery category. They are gaining sales growth as far as high single digits. They also said once again that they're seeing growth in health and wellness. Another increase that they're seeing is in private label brands. They said that that's been going on since the beginning of 2022. So they said that in the last few quarters, customers have chosen the private brands at Walmart at an accelerated pace. They said that net represents about 20% of their Walmart U.S. business. Another driver, that e-commerce growth, we saw sales up 24% in the U.S. E-commerce growth was driven by pickup as well as delivery. They also noted that customers are buying more items on Walmart Marketplace, and more customers are visiting the app and the website. And in addition to that, their ad business is booming. U.S. ad sales are up 36% once again here in the U.S., driven by that Walmart Connect business that they rebranded back in 2021. They're certainly doubling down on that as they expect to grow profit faster than sales in the coming years. The CEO, Doug McMillon, saying that higher margin business helps to drive that profit there. In the U.S., once again, that Walmart Connect sales increased 36%. Advertiser count grew 60%. And new advertisers as of June include NBC Universal, Roku, TikTok, and TalkShop Live. And so certainly Walmart benefiting from diversifying their profile. And CEO Doug McMillon saying on the call that they really do have a deep bench here.
Let's talk about back to earnings season, because that's usually strong for places like Walmart. So what did they say? Did they give any indication about that?
Yeah, well, they raised their guidance this coming year. In the Q3, they do expect sales to increase by 3%. They also expect full year guidance to increase between 4 to 4.5%. And while, we are seeing other retailers like Home Depot and like Target certainly, post dreary outlooks, Walmart very optimistic here. CEO Doug McMillon did weigh in on what the company is currently seeing and how it could look in the back half of the year. Take a listen.
Typically, when back to school is strong, it bodes well for what happens with Halloween and Christmas and GM in the back half. I do think our food and consumables percent of total in Walmart US will still go up. Part of it's what's happened with inflation and disinflation in the GM categories. But relative to what I would have thought 90 days ago or when we started the year, GM is holding up better than I would have guessed.
So gaining market share, a key strategy for them. But in addition to that, like so many other retailers that we've heard this week, CFO John David Rainey didn't shy away from the current headwinds that are facing the consumer. Take a listen.
There continues to be a reasonable level of uncertainty in the economic backdrop for the balance of this year. While inflation is moderated and employment levels have been steady, credit markets have tightened, energy prices are higher, and some customers face additional expense from the resumption of student loan payments in October. As such, we continue to be appropriately measured in our outlook.
And so certainly what we're seeing here is while there is a resilient consumer at Walmart and they're gaining market share, they're optimistic about that going into the back half, unlike other retailers that we've heard this week.
All right, that's all great. What was your vibe from the call? Did you laugh? Did you cry? What was
Well, investors right now certainly not loving what they heard on the call, but overall, I was pretty surprised, not necessarily surprised, but pretty wowed by the call. I think that Walmart certainly is striking an optimistic tone here. They're looking more optimistic than, say, other retailers in the back half of the year. And overall, it's looking pretty good as, once again, they continue to diversify their portfolio. I think what's to look out for is that health and wellness business that we continue to see boom for them as they strategize to really grow that part of the business. Also, their ad business looking really promising for them in the coming year as they put in-store interactive advertisements, and in Sam's Club, you'll see more ads on those TVs that you first walk into. And so lots of parts of the business are growing. And in addition to that, we're also seeing in this environment, customers turn to Walmart. And so I think lots of things working for them right now.
Although as analysts, an analyst told us earlier, Walmart price for perfection, Target price for desperation, and that perhaps reflects the reaction that we've seen in each of those stocks to their respective reports. Brooke DePalma, thank you so much for walking us through the conference call. Now let us take a stroll through the economic landscape. Global bond yields ascend as hawkish-sounding Fed minutes add to concern that rates will stay higher for longer. The U.S. benchmark 10-year yield sits near 2008 highs. UK gilts are jumping to a 15-year high. German bund yields are also rising. All of these moves suggesting investors are putting another Fed hike firmly on the table. The question now is it going to be September or November? Probably less important than maybe what even happens next year. Matt Lazzetti is with us now to walk us through all of this. Deutsche Bank Securities Chief U.S. Economist. Matt, I don't know that it matters a whole lot whether it's September or November or when or the next one's happening. People are like, forget about that. We're looking to next year already. And we're looking to cuts already. Is it too premature to look for cuts next year?
Yeah, so I think the big reassessment that we've seen in the bond market has been two things. One, maybe a little bit more in terms of rate cuts near term, but the bigger story is pricing out rate cuts from next year. For a long time, the market was pricing these steep cuts next year on the worries about recession. A lot of those rate cuts are coming out, and that's a big driver. The second is a steepening of the curve, some building back of term premia. Now that has come on the back of a few different items. Federal deficits have been higher. Treasury issuance has been higher. The Bank of Japan backed off of yield curve control. And so we've seen the longer end of the curve rise pretty substantially. So you have those two things that are going on at the same time, both leading to higher yields.
But is it realistic that we could see the Fed cut rates prior to them hitting their inflation 2% target that they've continued to really pound the pavement about?
Yeah, so there's a few different avenues that you can get there for rate cuts, even with inflation still above their target. One would be that you get a recession. That's been our baseline. That would very clearly lead to cuts next year.
But is that still the most likely that we see a recession?
For our baseline, it is, and it'd be more substantial than what the market is pricing. There's an alternative route to rate cuts, and that's the one that the Fed has been talking about most significantly. And that's that as inflation comes down, they basically cut rates so that their policy doesn't become too restrictive or too tight over time. And so they forecast 100 basis points of rate cuts next year purely on that type of story.
I guess what I'm trying to figure out as we continue to see yields climb is at what level that does finally start to become restrictive and constrictive for growth, because we haven't seemed to have gotten there. Like, when does that long and variable lag arrive?
It's a huge question. I think what we saw from the Fed minutes this week is they're struggling with that understanding exactly those lags. Typically, you think of it about 18 to 24 months, but we had this substantial front loading of tightening. We saw mortgage rates spike. We saw the housing market, collapse in terms of activity up front. And then there's a real question of, if yields don't move substantially higher for here, why should we expect growth to slow down? And I think that's what the question that everybody's grappling with. I think where we are probably seeing it so far, maybe on the global side of things, you're seeing some stresses occur within China, in some emerging markets. I don't think that has direct economic effects or big direct economic effects on the U.S. macroeconomic outlook. Where I think it might have effects is through financial markets. And so we've seen, modest risk aversion over the past several weeks. The spike in yields, I think, driving some of that, and some worries out of China driving some of that.
I'm not certain how many Fed meeting minutes that I've looked back through where there's been a mention of the volatility in the S&P 500. And I bring that up to the point in the question of, is this a Fed that's paying close attention to the markets? To what extent are the markets perhaps driving the Fed too?
Yeah, I think they will always say they're not just focused on equities, and that they view financial conditions broadly. And when Chair Powell talks about financial conditions, the number one thing he always mentions is real rates. And so I think that they would be encouraged in some ways that we're seeing 10-year real yields at highs post-pandemic. That you're seeing shorter end real yields moving higher, that you're seeing some pricing out of those rate cuts. I think the Fed will be encouraged by that. At the same time, they're seeing data, the retail sales report this week, which was very robust. They're seeing a consumer that's not slowing down. And the minutes this week made it clear, as Chair Powell did last month, that they need to see growth slow in order to have confidence on inflation. And so yes, real yields are high, but they probably wouldn't mind seeing equity markets a bit lower, credit spreads wider, broader financial conditions tightening.
I'm glad you mentioned the retail sales report, because I was going to ask you about that, because it was pretty remarkable to see that number. And I was reading a note from Krishna Guha over at Evercore ISI this morning, where he talked about the conundrum now on the part of the Fed, where inflation is coming down, or the rate of inflation is coming down, but growth is not. If it is just inflation, you just said that they want to see growth come down. What if it doesn't? What if you do continue to see disinflation, but you don't see growth slow?
I think it's all a question of magnitude. If we were to get all the way back to 2% without seeing growth slow and the labor market loosen, a fantastic outcome from the Fed's perspective.
Is that even possible?
We think it's unlikely. And the Fed, thinking about risk management, in the minutes this week, they talked, most officials still see substantial or significant upside risk to inflation. And a big part of that was the growth story and the labor market story. So I think they will think it's unlikely that you can get robust growth, a labor market with a 3.5% unemployment rate, pretty elevated wage growth, and inflation all the way back down to 2%. I think an environment which we could have is that you get inflation down to 3% relatively easily, based on the fact that supply side is being resolved and you're seeing some other pressures come off. Shelter inflation is going to decline. But getting from 3 down to 2% might be a more difficult environment without growth slowing.
Interesting. Great perspective and insight as always. Matthew Luzetti, Deutsche Bank Securities Chief U.S. Economist. Hope your summer's going great. Thanks for joining us.
Thanks so much.
Have you tried pickleball yet, by the way?
I played pickleball in high school, actually.
Wow.
So a long time ago.
I didn't even know it had been around
in high
that
school,
long.
Deep value right there.
High school gym class.
Oh, how
But have
funny.
not played since then.
Wow.
Okay, mind blown. All right, I guess we got to go to commercial break now. What do we do with that? My goodness. Thanks so much, Matt.
Thank you.
All right, well, your markets action straight ahead. Stay tuned. Watching Yahoo Finance. How would you describe the state of the consumer right now?
Well, I think the consumer is actually doing pretty well. I mean, look at the retail sales numbers that we had yesterday, and I think that's part of the good news is bad news story, that if the consumer's doing pretty well, we actually have some concern that we need to keep fighting inflation more.
Synopsys is a company that helps big names in tech design semiconductors and computer systems. The company will see its first ever leadership transition in 2024 as the current CEO, Art de Geus, steps down. It also just released fourth quarter numbers, beating on EPS and reporting record quarterly revenue. The company also raising its full year revenue guidance on strong design activity. Let's bring in current COO and president of Synopsys, the man who is going to be taking over as CEO as of January 1st. That's Sassine Ghazi, to discuss more. Sassine, thank you so much for being here. First of all, congratulations on stepping into that CEO role as of early next year. First of all, just to sort of set the table for our viewers here as to where Synopsys sits in the semiconductor ecosystem, if you will. Your clients are some of the big semiconductor makers. Talk to us about what services you provide to them to help them on their manufacturing journey.
Sure, Julie. First, thank you for having me. So what Synopsys does, we really think of us as the work engine for the semiconductor engineers, meaning customers like the NVIDIA, Apple, Intel, Samsung, etc. Anybody who design and develop a chip, they use Synopsys software to architect and actually design and verify the chip. And if you talk to any of those customers, we are very well known by every engineer in the semiconductor space, all the way up to their CEOs, because we're very critical to determine their competitiveness and their schedule and product differentiation.
What kind of demand or boom are you now seeing within the chip space of just people who are looking for chips that are relevant for AI needs?
So there are two factors that are happening really around us when it comes to chip demand. One, everything is smart, right? So your smart car, smart home, etc. So it's demanding a big need for more sophisticated semiconductor chips. The other mega trend that's super exciting is AI. With AI, in order to make it happen in reality, you need more sophisticated chips in the cloud or in the data center, as well as more sophisticated chips on the edge. With those two factors, the demand for semiconductor is unprecedented.
And I was trying to, as I was reading through your earnings and looking through the call here as well, I was trying to understand sort of the quantification of AI and its importance to you up to this point. You guys said on the call that on a trailing 12-month basis that AI chips account for about $500 million. Now, that's still not very much of your overall revenue, to be clear here. So what is sort of the opportunity? How quickly is it moving, and how is it being used?
So yes, you're right. About 10% of the company's revenue today is attributed to AI chip designs. Now, if you look at the macro demand for AI, I believe we all agree that demand is in early stage and is going to continue on expanding as more and more applications uses AI. And more applications means you need more and more compute. Therefore, in order to design the chip that goes into that compute, you need more and more Synopsys software in order to enable it. So the $500 million or 10% of the company is, I want to say, in early stages with an expectation to continue on growing very nicely.
And I think what people are trying to understand right now is, if I may, I believe one of your clients, NVIDIA, really changed the way that people were thinking about AI when it came out last quarter with its forecast. And now it feels like investors are trying to figure out where are the opportunities beyond that, where companies are seeing real revenue right now. So can you put that in perspective for us, not just for you all, but what you're seeing among your clients?
The more applications you have for AI, so one of the big application that we all got excited about and it became understood is ChatGPT, for example. But that's one application. There are many other applications in the generative AI space or in the overall acceleration of efficiency and productivity. It can be in any market, industrial, medical, etc. And for these markets, we are in that early stage of adoption towards these two vectors, either a productivity push or a ability to use AI in order to accelerate product development. So in that scope, Julie, is where we see the opportunity, and that's why I keep emphasizing it's still in an early stage of enablement and deployment from an AI application standpoint.
When you go about designing chips, especially considering the amount of fabrication capacity that's going to be brought online within the next couple of years, how do you have to think through the natural resources that you're tapping into as well, and really kind of lean into where there is an abundance of those resources so that you have a chip that is actually making it through the fabrication processes at scale?
Excellent question. I don't know if you have seen, on Monday we announced a very strategic partnership with Intel. And the primary motivation behind that partnership, as you know, Intel and a number of other manufacturing companies got money from the CHIPS Act. So that money is to build out a fab or a manufacturing capacity. But that capacity means nothing unless you're able to put chips into it. And we are the company that will be enabling Intel and other manufacturers to be bridging between the manufacturing and the chip developer, like the AMD, the NVIDIA, et cetera, to take those chips to those fabs. In that context, AI plays a huge role, because when you look at the engineers available to develop and design these chips, they're at all-time shortage. We don't have enough engineers to develop them. And this is where Synopsys plays a huge role in the automation and modernization of the chip design. So with AI, you can actually implement AI for chip design, where you can reduce the tasks from many engineers to fewer engineers in a much shorter time. And that's where the disruption and the inflection point is happening due to AI for chip design to support this increased demand due to cloud compute, autonomous driving, et cetera, et cetera.
Sassine, finally, I want to ask you about the leadership transition, right? You are only the second CEO that this company has ever had, is my understanding. The founder of the company is stepping down as CEO to become executive chairman. What are your thoughts on taking the helm there? And what's sort of your high-level goal for where you want to take the company in the next phase?
So Art started the company 37 years ago, and it's so rare to have a founder remaining CEO for 37 years with a lot of energy and vitality. I've been in the company for 25 years, so I did not join yesterday. Mm-hmm. And we have an amazing company, and that's why I've been here for 25 years. Now, as we transition between Art and I'm looking forward to continuing the momentum that we have created and the pace to support the growth that we see in our market. If you look at the last few years, we were able to grow the company actually in 3 years about 17% CAGR and improve EPS by 26%. We just reported Q3, which is a record quarter. So it's a perfect time to go into that transition and continue that pace and momentum moving forward.
Well, Sassine, we really appreciate the opportunity to catch up with you as you prepare for that transition. Sassine Ghazi, Synopsys COO and President, soon to be CEO as of January 1st. Thank you.
Thanks, Julie.
We've got much more markets action coming up. You're watching Yahoo Finance.
Companies are doubling down on influencer marketing. A new study from Creator IQ found that 67% of companies increased their marketing spending on influencers in the last year. Energy drink brand Celsius is one company investing in the trend, recently announcing a partnership with Jake Paul, among others. John Fieldley, Celsius Holdings CEO, joins us now. Great to have you here with us this morning.
Glad to be here. Thank you.
Okay, you've seen this intersection right now where the company has been able to kind of meet some of the trends of the new energy drink consumption with that other side of the intersection of influencer marketing. What really powered that decision, that strategy from the brand perspective?
Yeah, I mean, the company's been around. I've been with the company 12 years, and we're really rooted in fitness. So that's where our DNA is. Really, started off as a pre-workout. Those for individuals looking to improve their workouts, live better, and live healthier. And we've capitalized on that with overall health and wellness trends. With those growing, making us more mainstream. And then today, you mentioned Jake Paul with some of the influencers, Shaun White, we have many others. We're gaining more broader appeal, broader distribution. And if you think about just 10 years ago where fitness was, it's not as, it's mainstream today. If you look at all the number of gyms, the boutique gyms, the specialty gyms that are out there, fitness is in each and every one of our lives today, more than before. COVID has brought it out as well. I mean, health and fitness is key to living. And that's what Celsius is about. It's all about living fit.
I am curious how you guys decide which influencers to partner with, because Jake Paul, okay, he's not the first guy I necessarily think of when I think of fitness, and he's not unproblematic entirely, right? So do you sort of take risks on deliberately because that then gets the name out there? Like, how do you think through all of that?
Well, when we look at influencers, one thing we're big on, it has to be authentic. So really need to, be like the product. That's really critical. And Jake has been, as an example, Jake Paul, we partnered with him this year, but he's been consuming the product, over the years. So he's very familiar with it. Actually ran into him at a restaurant. That's how it all came together. We got talking about Celsius, his favorite flavor. Started off drinking our great tasting orange. What's interesting about Jake is that he, they call him the problem child. He came from social media, a big influencer, and he's also into fitness. He's moving into boxing and really about an advocate of fighter pay as well. So really changing what he's doing for fitness and sports in general. When we look at influencers, we have a variety of different influencers in all categories. Shaun White, great snowboarder, athlete, Olympian. And then we have a variety of different verticals that we target as, but most importantly, they have to be authentic to the brand. I think consumers today see through that, and that's really critical for us.
Yeah, Shaun White's the name that I shout out when I go off of any jump coming down a mountain. For sure.
Absolutely.
Whether begrudgingly or out of excitement. At the same time here, when we think about the growth for your company and Celsius, we were taking a look at the stock chart even coming into this. It's absolutely done amazing, even in kind of this interesting consumer environment where consumers are more picky, they are more choosy, and perhaps this is a little luxury that they've tapped into. So how have you gone about the pricing mechanism, the strategy there, and making sure that you're not a part of the trade down or the trade out, rather, part of that basket for consumers?
No, that's a great point. Our position, we want to be premium in the category. Celsius is a premium product. We have over 7 essential vitamins in it. We have green tea, ginger, guarana, biotin. Also thermogenic properties, help you live that healthy, active lifestyle. So we are a premium position. We're working on maintaining our pricing architecture, promotional strategies, to maintain that. We're watching consumers if they're trading down. One thing that's unique with the energy category is that consumers are extremely loyal, and we have we're seeing strong loyalty within the category, kind of like when the coffee category, we look like Starbucks and Dunkin' Donuts. So we feel we're pretty much not insulated totally, but somewhat protected as we grow and scale. And we also feel if consumers are going to pull back, they're going to pull back in other areas. Maybe that travel, maybe that extra, dessert at dinner, or where they're going to dinner, or cutting a meal out versus cutting their energy drink. Really part of a daily lifestyle and daily routine. And when you think about the DNA of Celsius with our fitness, that's part of that lifestyle that we live for, and that's what Celsius is about. We're in Barry's Boot Camp. We're in just partnered with Dog Pound. We're with some of the largest Gold's Gym, 24 hours, some of the largest institutional gyms and boutique gyms in the U.S.
When we talk about fitness and authenticity and social media and all of them coming together, apparently there's been a trend on social media where people say there is Wegovy in Celsius, and the other new classes of diabetes drugs that also happen to cause weight loss. How do you communicate the benefits of Celsius without there being just like flat out false information being spread out there? I mean, is that good for you guys that people are doing that?
I don't think so. I mean, it's there's a lot of false information on social media, right? It's all over. You see that on all platforms. We respond. It doesn't have that. We have, you look at the ingredient lists. There's a lot of false advertising that's out there just in general. It's something that every CPG brand or every company has to deal with these days. And we have a great social media team that stays active. If we see something really false, we'll make a complaint through that platform. You just have to be proactive these days because the false advertising that's out there or false comments, it's not good. You need to stay on it.
Speaking of pricing, it would be a lot more expensive if it had those drugs in the cans, I think.
So what goes in then when you think about not just the nutrition, but when you think about the makeup of what differentiates Celsius in its own kind of ingredients and its own, if you will, formula that goes into it? What is that differentiation?
Well, we have a proprietary blend with over 7 essential vitamins. We have natural flavors. Most importantly, what we hear is our refreshing flavors. We have one of the most refreshing energy drinks on the market, and we just evolved into expanding our Vibe line. We talked about pre-show the Tropical Vibe, which was a great addition. We just launched Cosmic Vibe, taking the Vibe line intergalactic. You can get it at Circle K. And we have other great flavors that are expanding as well. So flavor innovation is really key for consumers these days. We just partnered with Pepsi coming up on our 1-year anniversary. So really excited bringing Celsius to more consumers. We're in about 95% of reported stores through IRI right now. It's been great. You mentioned the stock price. The team has been working really hard. We just put up revenue of $326 million in the second quarter. That is more than what we did in all of 2021. So it's been we've been working really hard and really busy.
We were just showing the caffeine content, which is part of the reason the people buy Celsius. They want that boost from that and the other ingredients that you talked about. There's been a little bit of Chuck Schumer, I think of him, because he brought up some of the caffeine content in drinks like yours and others, being, not that the caffeine in it as of itself is an issue, but being marketed to children or younger people in particular. How do you respond to those kinds of concerns?
Well, we don't market to children at all. I mean, if you go back to even where the brand was born in the fitness community, in the gyms, and what's interesting, our demographic has historically been an older demographic. And it could be because of the 7 essential vitamins, the way the brand was built through Vitamin Shop and GNC and health and fitness. So actually our demographics skew at an older demographic than your traditional 18 to 24.
But even with the influencer marketing, because the influencers are sort of, that audience skews quite young, doesn't it?
Not in general. I mean, you're looking always 18 to 24. We don't partner with any influencer that's under 18. So we're really cognizant of that. We don't market to anyone under 18. We actually are 18 to about 44 plus. We have a lot of individuals actually that are 70 years old that call into the office and want free swag for their clubs and everything else. It's quite interesting, the broad demographic within Celsius. And I think that's what kind of separates us. So we're not really concerned. We don't market to anyone under 18. And caffeine content, if you have the right amount of caffeine, it's about 200 milligrams of caffeine. So if you look at your average coffee house, you're looking at a 12-ounce coffee that is a lot more than 200 milligrams of caffeine that's out there on the corner outside. So we think it's the right amount. We don't have any sugar. That's another thing we don't have. So a lot of these other energy drinks are combining an awful lot of sugar with caffeine, so you get this spike because of the sugar rush. And some of them have over 26 grams of sugar in them. So that fills up like a Ziploc bag, which is crazy.
You have a recent partnership with the MLS as well, which is like a lot of Energizer bunnies running around on the field for a long time, and perhaps that's exactly why Celsius wanted to partner there. You think about the next sporting deal that you would like to see come through. What sport makes sense next? Where are talks moving forward?
Yeah, well, we just announced the MLS deal yesterday, so we're really excited about that. And that talked about 90 minutes of a really great cardio workout within soccer, and it's a growing demographic as well.
Petrifying to me, but yes.
What's interesting with that partnership, we actually partnered with Inter Miami in February, and then Messi shows up 3 months later, so that was quite interesting. Yeah. Great timing on that. Some things happen, and you got to maximize the moment. But we partnered with Inter Miami prior, and then we just worked with the National League with our national distribution at 7-Eleven. plan and our expanded opportunities now. This is our first national partnership. We actually have the extended time sponsor, so that we're providing that essential energy for that extended time past the 90 minutes. And as we look at where we go from now, we have a partnership with F1 with Ferrari, so you'll find us in the upcoming races. Big race coming up in Vegas as well as Austin. You'll see us in snowboarding, downhill skiing. We're working on opportunities there. So really anything that's evolved, we're looking at opportunities where we can connect with consumers in this fitness lifestyle, bring Celsius to more consumers that want to live fit, live life to the fullest. That's in our DNA, and it's what we're about.
Do these partnerships add up to acquisition target?
Nothing's out of the question.
Okay, all right. We got to leave things there.
Full of energy, John.
Yeah,
Love
seriously.
it.
You've had 2 of these already today, 2 Celsiuses. All right, we'll see where you're at by 11 a.m. John Fieldly, Celsius Holdings CEO, thanks so much for joining us on set. Switching gears, everyone, streaming giants are hiking prices and betting big that you won't cancel. Hold my beer. Peacock and Disney are the latest to bump up prices, with Hulu now charging top dollar for its ad-free plan beginning in October. Well, for all this and much more, we've got Yahoo Finance's Dan Howley joining us now with his thoughts here. Hey, Dan.
What's going on? So
whittling down your streaming services?
Winnowing, pruning, taking down the number of streaming services I have. My wife and I are just budgeting because we're looking at getting a house, and I was going through some of these streaming services and just looking at the price increases and just overall the different types of price increases that we've seen over the past year or so is just mind-boggling. And so I'll just run through some of the big ones. Obviously, Disney Plus and Hulu, ESPN Plus, they just raised the prices there. Hulu without ads is now from $14.99 to $17.99. If you look at Disney Plus, that's up from $10.99 to $13.99. Max, HBO, whatever you want to call it, that went up $1 to $15.99. Paramount Plus, I subscribe to that. I have no reason why. I think it was to watch Yellow Jackets, and now it's just a waste of space for me. That's $11.99. $11.99. We have Peacock, that went up to $5.99 and $11.99. I subscribed to that for The Office, and I was just like, screw this. I don't like. The Office is great.
You could buy the whole box set and be done with it.
It was just pointless. And then Netflix, of course, everybody has that. That went up to $15.99 and $19.99, and they killed the lowest version they have. Now they have the ad-supported one for $6.99. Oh, and by the way, you have to pay $7.99 if you want to get someone outside of your household. So the prices are just continuing to rise. And I was speaking to one analyst who basically said we're past the gold rush era of streaming services. Now it's about the adult supervision era of getting profit, not eyeballs. So, I think what we're going to continue to see is people similar to what I'm doing, going through and saying, Jesus, all these prices are huge. I have YouTube TV as well. That jumped from $64.99 to $72.99. And I mean, I had that for the Mets.
So are you paying more than you did for cable at this stage?
Yeah. Don't forget Spotify, stuff along those lines. So, I subscribe to YouTube TV to watch the Mets. YouTube TV, you screwed up and lost a customer because you and SNY, you can't agree on anything. So now I don't have the Mets, so now I'm not watching them anymore. So I'm going to get rid of YouTube TV. I still watch Naked and Afraid on it because I hate trash TV. I love trash TV. But yeah, I think it really comes down to these price increases are just hurting consumers, and I'm one of them who's going to quit. Why do I have Apple TV Plus still?
I don't know.
I don't get it.
I think Naked and Afraid did prepare me for walking into the jungle in Costa Rica for like 5 minutes.
That'll do it. Look, I went camping once, and I tried to start a fire with the flint, and then I saw my friends drinking beer at 9 in the morning, and I was like, the hell with this. I'm going to go drink some beer.
And then you got out your Zippo. All right, Dan Howley, thank you so much. Appreciate it. Rochelle Akufos got you for the next hour trading. Keep an eye on those streaming services. Other people are probably canceling some. We'll be right back.
Welcome to Yahoo Finance. It's 11 a.m. on the East Coast, 8 a.m. on the West. I'm Rochelle Akufo. Here's a look at what I'm watching this morning. The latest Fed minutes are sparking fears of more interest rate hikes to come. We'll break down what this could mean for investors. And Margot Robbie is reportedly taking home a nice paycheck from Barbie. But is this a sign of a possible change to come in Hollywood? We'll discuss. Plus, after a brutal summer for the housing market, is the worst in the rearview mirror? I'll speak with an economist from Redfin coming up this hour. But first, let's take a look at the major indices this morning, 90 minutes into the trading day. Looking at a mixed picture here, the Dow up ever so slightly, just about 50 points there. We also see the S&P 500 just barely in positive territory. We're seeing energy and materials, the big gainers, tech, the laggard. And speaking of tech, the tech-heavy Nasdaq there under a little bit of pressure here, down 55 points, or about 0.4%. Let's also check in on what we're seeing with the Treasury market as well, as we're still digesting some of those Fed minutes. You see the 5-year there up at 4.442%, so up ever so slightly there, up about 1/3% on the day. Take a look though at the 10-year. We're seeing that is actually the yields on that are the highest since October and hovering near 2007 levels. So keep an eye on that. You can see that it's up almost 1% on the day, and the longest term 30-year yields up 1.22% there. As we can see, it's at 4.41 right now. Well, global bond yields are jumping today as hawkish sounding Fed minutes add to concerns that rates will stay higher for longer. The US benchmark 10-year yield sits at 2008 highs. UK gilts jump to a 15-year high, and German bond yields also spike. Now, the move suggests investors are putting another Fed hike firmly on the table. Investors are now seeing a 40% chance of a rate hike by November after the release showed participants are wary of the possibility that inflation will not ease and further hikes will be necessary. Now, a quote from the minute says, quote, most participants continue to see significant upside risks to inflation, which could require further tightening of monetary policy. Joining us now is Matthew Miskin, John Hancock Investment Management Co-Chief Investment Strategist. Thank you for joining us this morning. So we're seeing a lot of cold water now being thrown on a lot of this enthusiasm that we had seen in the markets. Do you think it's really sinking in? I mean, the Fed has been really saying higher for longer for months now.
Right, and it's almost been a full year. So this time last year, we had the Jackson Hole meeting, and Powell came out and said there's probably going to be below trend growth and pain to households and businesses. And a year later, we've got real GDP. According to GDP Now, the Atlanta Fed version is showing 5.8% real GDP growth coming out of Q3, coming into Q3 here. So you're almost seeing a reacceleration of growth. We think that this reacceleration is not what the Fed wants to see right now. They would like to see actually some of the loosening of the labor market. They'd like to see inflation come down, but stronger growth in the US, somehow remarkably resilient from these higher rate hikes, is going to pose a challenge for the Fed next week at Jackson Hole.
I mean, and we know that it really does show that the economy can take these rate hikes. But what are we looking at then? If we still see inflation obviously moderating somewhat in some aspects, still some stickier parts, but still seeing then this reacceleration of growth.
Yeah, it's such an odd complex of, in relative to history, this just hasn't happened often at all. But in our view, interest rate hikes take time to filter into the economy. An analogy kind of think about is when we did all the stimulus out of COVID, it was like an injection into the economy. So we flooded the economy with stimulus. And now the Fed has to slow down the economy, normalize it. And it's almost like sleeping pills, where you take these pills, you don't know how long it's going to take for them to really be felt in the body and the economy. And so it's taking time. It is likely still be felt by the end of this year and into 2024, but it's just been amazing to see how resilient the economy is. We've seen some fiscal side, some spending. We've seen a lot of anecdotal evidence of either blockbuster movies to concerts that are doing well in terms of the U.S. economy. But eventually, we do think this fighting the Fed for risk assets and for the market is going to start to wear down that market. And we think that's going to actually cause a bit more choppiness and a bit of a rotation into more defensive parts of the market as we move into 2024.
And you mentioned some of the blockbuster, movies that people have been spending on, the Taylor Swift impact, but you also noted the Inflation Reduction Act and more labor participation from women coming off of the heels of COVID as well. How much is that playing into what we're seeing?
I mean, you're looking into the economy and you're saying, how is it doing so well? And those are the two things that we see as the biggest drivers right now. So the Inflation Reduction Act had a pretty big side effect in that it created more CapEx in the US and specifically in the Midwest and Southeast. And so if you're going to build semiconductors in the United States, you got to build massive manufacturing capabilities to do that, or electronic vehicle parts, or just doing more wind type or alternative energy sources. All this requires huge investment. So right now, the United States is putting all this investment in, and it's not counter-cyclical. Usually the government does fiscal policy like this when we're in a recession. They did it when the inflation rate was too high. And so they thought they were actually reducing inflation. They're probably actually accelerating it, which is just a bad side effect in timing-wise. But then to your point, the women participation in the labor force is now about 50%. That is near all-time highs in this country. From the Barbie movie to Taylor Swift concerts, the women in the country are really stepping up to the plate in terms of the labor market, and that's filling that massive labor gap that we had. And that's likely one of the biggest secret weapons the country has. And we're, United States-wise, is holding up the best globally, economically speaking. One of the reasons we like the U.S. out of all the investment opportunities out there today.
And speaking of sort of the global look at things, we know that we're going to be having that Jackson Hole meeting, the global central banks really getting together here. And at the moment, really seem to be pulling for this higher for longer rate expectations as well. How important is this Jackson Hole meeting that's coming up before the Fed has its next meeting?
We actually think this one's going to be more important than usual. So some of these Jackson Hole meetings are kind of a non-event. You know, they come out of it. They're like, well, we did some research. Great. But this one, I think Powell wants to signal that, you know, they're still going to be hawkish and that, you know, September could be in play as a rate hike. I also think it is interesting in terms of talking about all these central bankers coming together. What's interesting is that while the ECB, the Fed, and the Bank of England are all saying, let's raise rates, let's get this inflation problem done, China's stimulating. And this is the worst time for all these other central banks that are wanting to slow the economy, normalize it, get inflation down. China last night even was starting to intervene in the market. And every time you see China economic weakness or market weakness, they start to pump money into the market. That then spurs risk taking and also causes commodities to jump. So oil prices are higher today. Copper starting to slow down its descent. So you've got this counterbalance where really a lot of central banks are going to meet up and say, we got to get this inflation problem. And then you got China, the second largest economy in the world, saying we're stepping on the gas to get our economy back growing. And it's this tug of war. And we think eventually the developed central banks win out. Right now, it's a tough backdrop to get that right.
So for retail investors who are trying to connect the dots between all this different data that's coming out of China and what this means for sort of investment prospects and how it impacts the US economy, what's the key thing to take away there?
Well, globally, we see the U.S. looking the best, economically speaking, earnings-wise. And the U.S. equity market is the highest quality market in the world. And what I mean by high quality, good balance sheets, high ROE, good profit margins, and good profitability. And we would really emphasize higher profitability, good quality stocks in equity portfolios today. That's leaning us into the U.S. versus the rest of the world. And then in terms of other opportunities, defensive stocks like healthcare or utilities, have gotten crushed this year. They've massively underperformed. We see them as relative value opportunities, and there's high quality income available today in the bond market. We would look at defensive sectors like healthcare and some bonds. I know bonds have been selling off. It's been tough, but the higher the yield, the more likely you have better total return going forward and nice income stream generation. Those are great opportunities in what is a challenging backdrop. So we would take a look at those.
Lots of great insights there. Appreciate you joining me this morning, Matthew Miskin, John Hancock Investment Management Co-Chief Investment Strategist. Appreciate your time today.
Thank you.
Well, the deal space has been relatively quiet for nearly a year, especially for tech, but things could be picking up back again soon. Joining us now to break down what's on the docket is Yahoo Finance reporter Ali Garfinkel. Ali, what are you watching?
Rochelle, after a long silence, tech deal making could really be making a comeback here. I've spent the entire week talking to a bunch of banking sources that I have, and all of them are saying that conversations that stalled even 3 months ago are now returning. They're back in the last 2 weeks where people now want to start making plans, firming up dates to either take an asset to market or go buy. And there are a couple of things that are sort of leading into this. The first one is the economy, the belief that there is macroeconomic stabilization sort of in the heading in right now, right? There is a belief, of course, for instance, among deal makers, of course, we'll see if it's true, that interest rates are stabilizing. Now, I think the way I would explain it is this, in real estate, the conventional wisdom is location, location, location is what makes something good. In deal making, what makes the right time for a deal is stability, stability, stability. And there is a belief that that happens. Now, we'll see if that plays out. But the other thing that is also really moving things forward is, you guessed it, enthusiasm around AI. It's the sort of thing where VC dollars are flowing into the space, even in a quiet year for VC. And we're already seeing some examples of deals that people are really excited about in AI. The most obvious example of this, of course, is Databricks' $1.3 billion acquisition this summer of Mosaic ML. And the last thing, of course, is the backlog. There's a dreaded backlog that's sort of been in place for a while, and deals that would have gotten done, say, 18 months ago are now being resurfaced in a lot of these conversations over the last few weeks. So the way I would explain it, Rochelle, is that deal making is sort of like making wine, right? It's both art and science, and you can have all of the tools, but if you don't have the weather, if you don't have the environment, it's going to be tough.
And much like wine, all tech is not created equally, as we've seen with NVIDIA sort of off to the moon so far this year. But what sectors should we be watching within tech as deal making returns?
All tech really is not created equal, but in this case, don't look for the biggest deals. It's really easy to want to think, oh yeah, we're going to see another $69 billion deal like the Activision Microsoft deal. That's probably not on the table. Bankers are behind closed doors calling this the year of the add-on. It's going to be a year where there's going to be a lot of consolidation, a lot of folks looking for capabilities that they might not have otherwise. Basically, the reason that add-ons are kind of going to be sexy this year even is that they're easier to finance in a high-rate environment, and they're not going to run into antitrust issues, which is something that bankers are more and more talking about, even bankers who are doing deals in what's considered the middle market between $250 and $1 billion. Some key areas to call out here are cybersecurity, and to me, this is the one that I think is most primed for some really notable deals. Think about it. It's a perfect sector for deals, right? It's mission critical. It's fragmented. And we've already seen some examples of really big deals, even in tough environments. We only need to look back last year to Google's $5.4 billion acquisition of Mandiant. Otherwise, keep thinking along the lines of mission critical, right? Risk and compliance, especially in a more antitrust-centric world, risk and compliance is seeing a real spike. Fintech is something that is going to be in the digital transformation theme that we hear from companies all the time still. And of course, AI. Now, be careful with AI. Remember, the VC dollars may be flowing in, but it's still far lower than what we would have seen, say, in 2017, 2018. It's also worth noting that a lot of these AI companies that folks are excited about are pre-revenue. So in the end, think about this as the year of consolidation, the year of the add-on, not the year of the mega deal.
It certainly makes sense. And as you mentioned, without trying to draw the ire of regulators, as we've seen it, antitrust regulators clearly on the prowl. Great stuff there. A big thank you there to our very own Ali Garfinkel. All right, let's take a look at shares of Adyen. Europe's Stripe rival is plummeting today after reporting worse than expected sales and a drop in profit in the first half of the year. Now, the company saw revenue grow 21% from a year ago, but missed analyst expectations. The soft report is being attributed to increased hiring, higher wages, and its clients in North America pushing towards cost savings. Now, fintech companies like Adyen have been under pressure year to date as high interest rates sour investors on the appeal of these growth-oriented companies that usually need cash injections. We're keeping an eye on that one today. All right, stay with us. All your markets action just ahead. Stay tuned. You're watching Yahoo Finance.
We got to know, Barbenheimer, have you taken place in the phenomenon? Did you see both movies? Did you see either or?
Oh, I feel bad. I haven't seen either yet. It's on the plan. I plan to go. I just have to get it on the books.
Okay. Plenty of pink there in the theater when I saw it. I got dressed up myself, so highly recommend for some people to take part. It's, fun summer activity.
The battle over the abortion pill mifepristone is escalating. That's after a US appellate court said the FDA could not authorize expanding access to the drug, sending the fight to the Supreme Court. Yahoo Finance's Alexis Keenan joins us with the details. Hey, Alexis.
Hi, Rochelle. Now, this decision, it comes from a split 3-judge panel for the Fifth Circuit Court of Appeals in New Orleans, and it is contingent on a Supreme Court review in this case, but it's important because it will factor in when the justices consider this issue. And the main issue here is the question of whether the FDA overstepped its authority when it originally approved mifepristone and also when it expanded access to the drug. Now, mifepristone is the first in a 2-drug regimen to induce abortion. It allows women to carry out an abortion at home. And in this ruling, this mixed ruling, the judges here said that the FDA's original approval of the drug, that happened in 2000, that could stand, but that the expanded access, which was through telehealth appointments as well as through mail order prescription, that had to go. Now, this case is brought by both individual doctors as well as a group of healthcare providers who oppose abortion. They say that the FDA ignored risks of this drug both in 2000 when the first approval of mifepristone happened, also in 2019 when it approved a generic version, going forward all the way to 2016 when they expanded use up to 10 weeks into pregnancy, and then in 2021 during the onset of COVID-19 when the Biden administration went in and said that these drugs could be obtained by mail, and that did away with the requirement that was previously in place by the FDA where women had to go in person for in-person doctor consultation in order to obtain these drugs. Now, these plaintiffs, they say that they are being harmed because they're forced to carry out abortions that go wrong against their will. They also say that they are required to expend their resources on abortion when they would rather spend those resources otherwise. But as of now, there are more than 26 states that have either banned or limited abortion. So this decision, very important, and the Biden administration has already said that it does intend to ask the Supreme Court for a review. The Supreme Court said that it would put this decision on hold, so it's not going into effect as of yet until and if it does receive a request for an appeal and to take up this issue. Rochelle?
And Alexis, the company that makes the brand name of this drug joined in the lawsuit. What are they saying?
Yeah, so that company is Danco, and they responded to this decision this way. They joined in this lawsuit. They were not an original defendant. They said the panel's decision seeks to undo FDA actions that were well supported by extensive safety and effectiveness data from clinical trials and real-world experience in millions of patients, and that are decisions Congress is entrusted to the FDA. So they're saying that the Congress has already authorized the FDA to carry out the decisions it has made, but that is the center of this debate, which will look like it's going to be headed to the Supreme Court.
We'll certainly be keeping track of all of that. Appreciate that update. Our very own Alexis Keenan. Thanks so much. Right, shifting gears now, July saw a slight uptick in consumer spending, with household use of credit and debit cards up 0.1% during the month. Both Barbenheimer and back-to-school spending played a part in the increase. That's according to recent analysis from Bank of America. Now, while some high earners may face pressure from slowing wage growth and a cooling labor market, most remain resilient. But can August continue the upward momentum? David Tinsley, senior economist for the Bank of America Institute, joins me now to break this down. Thank you so much, David. So let's talk about this July data, because there's a few factors in there in this consumer checkpoint that make things a little bit different from your typical June month as we saw.
Yeah, thank you for having me on. You're exactly right. So July was very solid in our data, and we have a perspective from 68 million Bank of America customers. So it's a very good barometer, we feel, of the US consumer. And our data showed spending on the month up 0.7%. Good momentum, and really interesting that services and goods, the retail side, both strong. But there are some specials, if you like, in the month, as you're referring to. One was the early July 4th holiday. That looked in our data to be very solid. Then there were some mid-month online promotions. And then, really interestingly, of course, we had Barbenheimer at the end of the month. And when we look at our data, July was solid for restaurants, eating out, It was also solid, interestingly, for clothing. So maybe people were getting that pink gear in ahead of going to the movie theatre. So a few specials, but overall, the resilience of the consumer continues to look, really reassuring, I feel.
And there does seem to be this tale of two consumers that was noted in the report. Your affluent consumers there feeling the pinch more than lower and middle income. Why are we seeing that disparity?
Yeah, that's really interesting. So what we can do with our data is we can look at the wages and salaries going into customers' accounts, households' accounts, and tier them by income. And when we do that, we see that higher earners, higher income households, their wages and salaries growth is pretty much flat relative to a year ago. And for middle and lower income, it's sort of 2-3 percentage points higher than that. One of the reasons seems to be a slower labour market at the top end. When we look at unemployment payments into people's accounts, we see them rising 3 times faster for higher earners than for lower earners. So perhaps some of the stories around tech layoffs, financial sector layoffs are at play there. And I think that's probably the main drivers. I mean, the good news is that really across all income tiers, there's still quite a lot of these deposit buffers in people's accounts. In other words, relative to 2019, people continue to have raised levels of cash. So hopefully the downturn we've seen to date at the higher end is already largely behind us.
And David, how sustainable do you think the savings buffer is? Because at the same time, we're also seeing this rise in credit card debt as well.
Well, the savings buffers are there. They're up across all income cohorts, sort of 30%. And if you're looking at households earning below 100K, they're up sort of 50%. They are trending down pretty slowly, but it really is very slowly. And we did some simple scenario analysis in our consumer checkpoint in which we projected forward. We projected forward in a hypothetical sense where those buffers would go if they carried on decreasing at current rates. And if you do that, you get well into 2024 before the buffers reach 2019 levels. So, the dynamism on the consumer side of the US economy looks pretty resilient, really, I'd say.
And so then as you check in on the state of the consumer, especially on the heels of what we saw with the hotter than expected July retail sales data, how long do you think the consumer can stay this resilient?
Well, I think it comes down to, as everything always does, the labour market. So while the US labour market remains in pretty good shape, and of course there has been some slowdown in payrolls, but it's relatively modest to date, then I think as consumers really see their labour income rise at a steady pace, they will continue to spend. We might get the odd month of retreats, but by and large, the second half of the year should be pretty solid. So, I'd be pretty upbeat about the momentum going into the end of this year.
And we did obviously, coming out of COVID, a lot of focus on spending on goods, but we are seeing that shift then to services. Do you expect that to start balancing out at some point? Or is it really going to be about what people are willing to spend on services?
Well, we saw this rotation away from goods towards services all last year and into a good chunk of the start of this year. So people started going to the movies to watch Barbie, etc., and more. They were buying less goods. Actually, just recently in the data, the goods spending seems to be bottoming out and coming back a bit. So, that's early days. It's early days, but there are some signs really that rotation may have largely played out. And so from here, you might get a much more balanced picture of goods and services spend.
We'll certainly be keeping track of that. A big thank you there to David Tinsley, Senior Economist for the Bank of America Institute. Thank you so much. All right, we have all your markets action ahead. Stay tuned. You're watching Yahoo Finance. Barbie's blockbuster run is proving to be beneficial for its stars as well. Margot Robbie is set to rake in about $50 million from salary and bonuses, according to Variety, as the film climbs to over $1 billion at the global box office. So is this a sign of change to come in Hollywood? Well, Yahoo Finance's Alexandra Canal joins us with the details on the dollar. Good to see you, Ali. So what are you watching?
Yeah, so this is very interesting to look at when we think about Hollywood and the pay gap that's existed for quite some time. Certainly Margot Robbie receiving $50 million, that's in both salary along with box office bonuses. It is a significant fee, especially as you compare that to other female stars. However, if you take a look at some other male actors that are traditionally higher paid, it pales in comparison. We have stars like Tom Cruise, Will Smith, who have received $100 million for their films. And this is not anything new in Hollywood. It wasn't that long ago where Michelle Williams, she brought to everyone's attention that while doing reshoots for a movie, she received less than $1,000, while her co-star, Mark Wahlberg, received $1.5 million. And a lot of experts say that Hollywood is really a microcosm of our current society and a lot of different industries, especially since Hollywood leans further male. According to a recent analysis of government data, women earn about 77 cents to every dollar a man earns. And that has somewhat improved over the years, but still a pretty significant gap. Now, when we think about Hollywood and some ways that female actors, directors, producers are trying to bridge that gap, a big part is creating their own projects. We've seen Reese Witherspoon launch her Hello Sunshine Network that is rooted in telling female stories from female authors. That is one way that women can really try and bridge that gap. But really it all comes down to the studios and how they can help in making sure that their female stars are getting paid just as much as their male stars. But I think that's an ongoing conversation that we're going to continue to have. But certainly with Margot Robbie plus Greta Gerwig, the first sole female director to reach that $1 billion club at the box office, that is really, really positive when we think about the role of females in Hollywood and how that could inspire the next generation. So something definitely to continue to watch.
Indeed, important to highlight that. And of course, in terms of the Hollywood strike as well that's coming on, that's also going on in the background, what can you tell us?
So the latest here is still TBD. We did see the writers meet with studios on Friday. However, that ended in mixed results. That's according to sources at Deadline. Now, there were some concessions on the studio side. Bloomberg had a report saying that the studios had made concessions on the role of artificial intelligence, which was a big concern, along with higher streaming residuals and higher salaries. But we know that the writers have been really steadfast in their language, and they know they have a little bit of leverage here. So until they get everything they absolutely want, with the terms that they want, I don't think we're going to see that side bend right now. There's no indication whether there's going to be a new set of talks, a new set of meetings, but hopefully we can continue those negotiations because we're heading into that critical fall season. We're well past the 100-day mark for the writers, and then we have the SAG-AFTRA strike for the actors continuing as well. So it's sort of this double whammy effect that is only going to hurt Hollywood and that ecosystem more the longer it goes on.
Indeed, and at some point, obviously, we're going to continue to see that showing up in the content as well. I know you're keeping track of all of that for us. Appreciate that. Our very own Ali Canal. All right, well, all your markets action just ahead. Stay tuned. You're watching Yahoo Finance.
If there was one streaming service that you had to cut, what would it be?
Oh, I have to admit, I've been a little annoyed with Max. It's so hard. Like, every time I want to download stuff, it's so limited. I find it challenging.
Have you finished everything that you wanted to watch on there, and now you're just kind of like, all right, I'm good to go here?
Yeah, I mean, I took a trip to Hawaii for a work trip, and I was on the plane so long, I needed more. And I have to share it with my husband, so that makes it challenging, you know, like, because he wants to download a lot too, so.
Certainly.
Yeah.
The housing market has been worrying investors and consumers all year, and Goldman Sachs recently revised its forecast for home prices. Let's bring in Yahoo Finance's Danny Romero to break it all down for us. Hey, Danny.
Hi there, Rochelle. Well, Goldman Sachs is changing its call. The team there is forecasting that home prices will rise about 1.8% this year. That's different from their previous call where they thought that home prices would fall about 2.2%. Why does this matter? Well, with home prices going up and mortgage rates hovering around that 7%, home ownership is really looking bleak for a lot of Americans. Goldman's team has previously thought that rising mortgage rates would cause home prices to go down. Well, home prices have fallen about 13% from last year's peak, but prices are still higher by about 26% than they were during the first quarter of 2020. Now, with mortgage rates rising, home prices also moving upward due to that lack of supply, it's time to change that call. So to give you some perspective, inventory for homes on sale sits at 1 million compared to what it was before the pandemic, where it was closer to that 2 million mark. So still not enough homes listed for sale right now, Rochelle.
And Danny, rents are also causing a lot of concern. What is Goldman saying about the rental affordability?
Homeowners, well, rents. A lot more people are going to be staying in the rental market. Homeownership is such a great way to build wealth, but not a lot of people can afford a home right now. And so that's keeping a lot of people in the rental market, keeping those prices elevated. That means that that's also adding to the inflation picture. So the tension between homeowners who like rising home prices because it helps with their home equity and potential buyers who obviously want those home prices to be lower, that means that affordability will be a discussion on Capitol Hill, especially as we head into this election year. We might hear a lot of these home associations really lobbying for some change. An example of that is some tax incentives when it comes to investors, real estate investors. So that might be something that we hear down the line, Rochelle.
Yeah, people are certainly going to need some incentives to give up their comfortable mortgage rates and have to, end up paying more if they have to move. Appreciate that update there. Our very own Danny Romero. Well, staying with housing, mortgage rates are staying high. Last week, Freddie Mac data showed that both the 30-year and 15-year mortgage rates were approaching 7%. Now, with that in mind, mortgage rates are not the only thing worrying investors about the housing market. Home builders are reporting a significant drop in buyer traffic. Inventory is at low levels and sales have seen a stuttered recovery. Redfin's CEO Glenn Kelman said that the market has hit rock bottom, adding that sales volume couldn't be worse. And if the mortgage interest rate were to continue increasing and hit 8%, analysts are saying that things will only get worse. Let's bring in Redfin Chief Economist Daryl Fairweather to discuss more about this and about the state of the real estate market. Good to have you back on the show here. So we saw Redfin out with a new report this morning that new builds making up nearly a third of single-family houses on the market. Tell us, what is this all doing now in terms of the state of real estate right now?
There is a real inventory problem in the housing market. There are about 18% fewer homes for sale now than there were last year. And last year wasn't great for inventory either. So if you're a buyer looking for a home, chances are you're going to be seeing a lot of new construction relative to the number of existing homes, which has been great for builders in this really hard market given mortgage rates and has meant that building activity is continuing and contributing to GDP.
But then when are we going to see affordability catch up with that? Because a lot of homeowners, obviously, they can afford to sit in their homes for longer, but you have renters trying to get into the market and just not being able to afford these homes.
Well, affordability is complex. It's not just prices, it's also mortgage rates, and mortgage rates are near 7% when they were at 3% during the pandemic. So that is a huge jump in the monthly mortgage payments that buyers would have to pay. Now, if you're paying cash, you can avoid that, but that further exacerbates this inequality problem in housing where the wealthy can find a home and build equity, but people who are just trying to break into the housing market are having a very difficult time.
Now, for some people, they say, look, no matter what the interest rate is looking like, it's better to just sort of buy a home. But as you're trying to sort of weigh the buy versus rent discussion here, what should people consider in this sort of environment?
It's really about the long term. So if you're planning on staying in your home for 5 years or more, buying is the way to go because prices will go up over that horizon. And when you go to sell, you will have equity, or you can not sell and just stay put and not have to worry about rising rents. Rents aren't going up so fast right now, and it is more affordable to rent a home than to buy one in almost all of the country. But in the long term, we do expect rents to continue to grow. And if you buy now, you can at least put a cap on what your monthly housing cost is going to be.
And as a lot of people sort of moved around during the pandemic, trying to get the most bang for their buck when they were working from home, we saw obviously, the Southeast really benefiting from that. In this sort of environment, are there certain states or major cities that are really benefiting the most, or where people can really get the most bang for their buck right now?
Well, benefit, it kind of depends on who you're talking about. The homeowners in places like Florida are probably happy to see their equity go up as so many people have moved into the state. But the renters and people who are just trying to get their foot in the door in the housing market are probably really worried about how fast housing has gone up in price. And that's for rentals and for homes for sale. Now, in places on the coast, like coastal California, prices are down, but mortgage rates are so high that if you're a home buyer, it doesn't really compensate for that. So you may be glad that prices are down in places like Los Angeles, San Francisco, but it's still not easy to get into the market if you're a first-time home buyer.
And something interesting that Redfin came out with, a report showing that the typical teacher can afford just 12% of the homes near the school that they actually work at, and that's down from 30% in 2019. So in terms of affordability for your everyday person who's now having to pay more just to try and live closer to work, are we getting any signs of that perhaps tempering at any point?
Not in the near term. And what was so interesting about that report is that places like Nashville and Denver that haven't really been at the top of the list in terms of being really expensive are some of the places where only 1% of homes for sale are affordable to a teacher. So that's very worrying that in more parts of the country, we're seeing this big divide in terms of who can afford to live close to where they work. And we need to build a lot more, especially in these places that people want to live, in order to combat that and to make it easier for people to just have a home and go to work and live their lives.
And in terms of the things that help get, more houses on the market, things like labor improvement when it comes to home builders, the cost of lumber and things like that, are we starting to see within those sectors some improvements here? Or when will we see enough improvement to balance out the demand that's out there right now?
It's still a challenging environment for builders. They have a hard time getting labor because there's not a lot of people skilled in construction in the US, even though we could bring them in through immigration policy. Currently, it's just very difficult to hire people. And the materials costs have gone up considerably since the pandemic. There aren't the supply chain shortages, so it's not like builders can't get what they need. They're likely just paying more for it and having to pass that cost on to the buyer.
I do appreciate you joining us with your insights. We'll be keeping an eye on those rental and mortgage rates as well. Big thank you to Redfin Chief Economist Daryl Fairweather. Thanks so much. Well, the most recent US data says that the rental price that we've been taking a look at, that's going to be our chart of the day that we're looking at the moment. US rent is seeing some softening, but consumers still facing some high prices, looking at year-over-year rent growth slipping below that 1% mark. Now, as with that in mind, it's still taking a toll on consumers. Moody's Analytics found the average share of household income spent on rent hit 30%, classifying most American households as rent burdened. Now, the US is certainly not alone in its fight to lower rental prices. In the UK, July inflation came in slightly above estimates at 6.8%. And with rising inflation, the United Kingdom's private rental prices rose at their fastest pace year over year on record, seeing a 5.3% change in the past 12 months. The Office for National Statistics found that the UK began to see an increase in rental prices in the second half of 2021. And it's Wales that's seeing the most change, with its climbing prices compared to other parts of the country. That data suggests that it increased by 6.5%, with Scotland coming next with rental prices up 5.7%, and then England seeing that 5.2% increase as well. All right, all your markets action still ahead. Stay tuned. You're watching Yahoo Finance. Shares of Cisco up more than 3.5% this morning. The networking giant beat big on the top and bottom lines in its fiscal fourth quarter, boasting record performance and calling out $500 million in AI-related orders. But despite the beat, the firm was slightly weaker than expected in their full-year guidance. Yahoo Finance executive editor Brian Sozzi spoke earlier with Cisco chairman and CEO Chuck Robbins about that stellar quarter. Take a listen.
Well, I think the primary difference between some of our peers is that they have a higher concentration or a higher exposure to the service provider segment, which was weak for us as well. But we have a much more diverse book of business, and so the enterprise and public sector and commercial all offset it. But look, it was one quarter. Teams did a great job. We're really happy with how they executed, but still a lot of dynamics out there.
And the margins in your business up pretty significantly as well. Is that just inflation coming down and you benefiting from that?
Well, a lot of it is a lot of the costs that we incurred with the supply chain challenges have subsided a bit. But it's also just the teams do a great job. Our supply chain team and our engineering teams do a great job on just continuing to find efficiencies in how we build our products.
This is a strange time in the economy. And look, today we have Walmart coming out here saying more people making over 100 grand are shopping its stores. Who would have thought? It's Walmart. What's your read on the economy here? Make sense of it for us.
Well, I'm not sure I can make sense of it for you, but I think it's clearly mixed. I mean, we as I said, we saw improvement in our commercial, which is sort of the mid-market down. We saw improvement in our enterprise business, and public sector was pretty steady. But service provider was very weak, and I think there's industries that are doing okay. We saw financial services, transportation was strong, but I think it's just a little mixed and just a lot of dynamics that we're watching on a very regular basis.
What are you most concerned about as we go into the back half of the year from an economic standpoint?
Well, first of all, I think that technology has become so core to how organizations run. This is it's not an optional thing. It's not a cost center. It's not some underlying ERP system anymore. It's deep in the heart of the strategy of these organizations. So there's not as much likelihood that you just completely stop spending on technology. Most of our customers will say, that's the last thing we'll stop spending on right now. They're being more thoughtful about which projects are being funded, which ones are the most important, and which ones that they're going to focus on. But as we look to the second half of the year, I think obviously getting inflation under control will be really important. Geopolitical dynamics around the world are very important, and hopefully we will see inflation continue to subside over the next few months.
What's your read on the China economy? I think markets are really under pressure right now because of a China economic slowdown. You have exposure there. Are you seeing that?
Well, we are very lightly exposed to China. It's less than 2% of our business, so it's not a significant part. But clearly, it seems to not be coming back online as fast as everyone expected them to. And I think that they'll continue to work the policy. They'll lower their rates, which was interesting. And I know that the economic growth in China is one of the most important topics for the leadership there, so I would expect they'll continue to make whatever moves they need to make.
Do you think we'll see, or are you seeing any signs of a contagion? China slowing down, we're going to get that here in the U.S.
Not at this point. In fact, we saw improvement sequentially in the U.S. Again, it was one quarter, but we saw improvement.
In terms of sequential improvements, you did call it out in the earnings call. Where are you seeing customers come back a little quicker than you thought?
Well, the enterprise in the United States, our large enterprise customers, particularly financial services, it was our largest enterprise software agreement quarter in the history of the company. So, big customers making big commitments, and didn't hear a lot of, well, I think we're just going to push that off a bit. When you think about the need to invest in cybersecurity, the need to invest in this whole technology re-architecture for this multi-cloud world we live in, everybody's rebuilding applications and needs observability and insights that we can provide to them. Everybody's trying to solve this hybrid work problem, and everybody's focused now on leveraging technology for sustainability. So every customer, and so we're just fortunate there are a lot of things that we have a role to play in.
When does Cisco start cleaning up on AI?
Well, it's important to understand the actual technology, and these GPUs, which are the brains in these AI networks, they have to be connected. And there's a technology that has existed for a while that is currently connecting those. And we build, obviously, Ethernet infrastructure, which is what the cloud providers want to move to. And so we're getting some early wins with some of this next generation Ethernet. But we think, that the FY24, which we're just starting, we'll see some benefit, but we think the real move to this new technology for connecting these GPUs will be in fiscal 25.
So you've incurred a $500 million in the most recent quarter from AI-related, chips, Silicon One, is it called?
We said we've taken $500 million in orders to date. It wasn't all in that quarter.
Wow.
It's actually systems that are connecting these AI processors, basically. So they have to be connected at the end of the day. And so we actually provide the networking equipment underneath. And we think that the opportunity over the next 5, 6, 7 years could be, 3 times what the original cloud build-out was.
Well, that was Cisco CEO Chuck Robbins speaking with our executive editor, Brian Sozzi. Well, let's do a final check of the markets as we head into the noon hour. As we saw, we went from a mixed picture to all red across the board here. The Dow now off more than about 50 points there. The S&P 500 also under pressure there, but ever so slightly by about 4 points. And the tech-heavy Nasdaq, tech being one of the biggest laggards in the S&P today, we're seeing that's down about 50 points or 0.4% there. We're seeing rate hikes continue to weigh on markets and continuing to weigh on investors, wondering about that higher for longer scenario as well. Let's also take a look at some of the trending tickers as well. As we just heard there from Cisco, that does still remain our top trending ticker right now on Yahoo Finance. And of course, taking a look at Walmart, considered a bellwether for the consumer, as well as you just saw there. And something that a lot of people have been wondering, how resilient can the consumer be? As we saw with retail sales for July, still strong, at least for now. As we can see there, top trending tickers, Cisco, Wolfspeed, and Coinbase. A lot of action there in the crypto market as we saw those crypto futures for Coinbase picking up. Well, that does it for now. I'm Rochelle Akutho, but I'll be back with you tomorrow morning. I'll see you then.